Please note that this meeting is being recorded and will be posted online with the other board materials, which are already posted. We'll be taking roll call by name for all votes, and unless there is an objection, a motion and a second will be counted as yes votes. Finally, texts or other recorded communications between board members during the meeting, even on personal phones or public records, to the extent they concern the meeting. We'll now do the roll call for attendance.
Very good. Ms. Lynch.
Present.
Mr. Roberts.
Present.
Mr. Ward.
Present.
Treasurer Briner.
Here.
Note for the minutes that Ms. Shipping Russell is absent, but we do have a quorum.
All right, thank you. So in accordance with the State Ethics Act and the board's code of ethics, it's the duty of every board member to avoid both actual and potential conflicts of interest. Does any board member have any known conflict of interest with respect to any matters coming before the board today? So please identify the conflict and refrain from participation. That's what I would have guessed. All right. I'll skip opening remarks, but we'll just go straight to approval of the minutes. Those minutes from the February 25th, 2026 board meeting are in your materials. Is there a motion to approve the minutes? So moved. Thank you, Mr. Roberts. Is there a second?
I'll second.
Ms. Lynch, call the roll, please.
Mr. Ward.
Aye.
Treasurer Briner.
Aye. All right, minutes are approved. Let's move over to major initiatives and performance update, and I'll hand it over to Kevin.
Good morning, everyone. So we flip the agenda today has got an approval item in the form of the budget, and then we're recommending a new system of administrative fees as well. Beyond that, it's mostly intended to have a fair bit of white space in terms of the agenda. And so the major initiatives, performance update as well, won't take that long. And we have two asset classes, the broader teams presenting, private equity and public equity. So we'll have the full teams up for each of those presentations. We only allotted an hour, but we have a lot of flex time because of the other topics are not that long. So in terms of an update on the transition to NCIA as a freestanding agency, things are moving along fine. We've gotten everything so far accomplished pretty much on time. The strategic plan, the budget are coming up today. Like I mentioned, the kind of the ongoing work of filling positions. We've hired 2 additional people, an accounting supervisor who supervises himself at the moment. Then we've also hired in a real estate portfolio manager who will join us mid-month in June. And he's coming from a Canadian plan, has experience both with U.S. funds and U.S. directs and overseeing separate accounts. So we're looking forward to him joining the organization. We've got candidates for head of HR. So we're moving that along. I hope to make a decision in the near term. And then as you'll kind of see when we talk about the strategic plan and AI and kind of the importance of that our function going forward, we're thinking that we may move up some of our IT work and scoping for what our business model will be, how much we do internally through the department, which is currently a shared services, the IT function, how much we outsource. But we've been talking to consultants and users in the industry as well around AI. And we're just thinking that that's something we probably need to accelerate relative to the initial plan, which was to really push that off until mid-27. So
Kevin, quick question, maybe for later, but I'll ask it now. How are you thinking about combining? So I know you're thinking about AI a lot, but as you think about roles that maybe we don't necessarily need because of AI, different roles you may want to hire because of, integrate them. As you know, I'm a huge fan of pushing this as far as one can at any organization. But how are you trying to incorporate that into how you're thinking about positions?
I wouldn't say that that's fully baked in terms of like what the implications are. So far, we're using it primarily as a productivity tool around some of the projects. So we've drafted, I'll actually fast forward, like policy work. Policy work has turned out to be fairly expeditious because we're able to utilize publicly available information and any information that we have inside of our firewalls that would be subject to public records requests. So that's kind of the rules of the road. So for policy development, we're able to bring in all kinds of sample policies from other public pension funds, and even corporations occasionally publish these things to look for best practices and then research papers. And basically it'll take a couple hundred hours and boil it down to about 15 to 20. So it's a pretty significant time savings. Chris has led the charge on this administrative fee structure, the budget as well, and we're able to use AI for creating some of that work product as well. So we bid out the administrative fee project, would have been about 200,000 to get the project done. Through a consultant, we decided to do it internally, and really hour-wise, it was a fraction of what we would have put in just managing the project, much less paying 200,000 to a consultant. So as of now, just to be blunt, it's still a bit unformed. I think the way we're positioning it in our strategic planning discussion is first productivity, then decision support. I think the decision support is the part that we still need to kind of figure out.
Training, what are you doing training wise kind of across the broad staff?
Well, we're really in the midst, the early days of still rolling it out. So OpenAI, ChatGPT, we started with 12 employees and that's rolling out to the broader organization. We've had Copilot for a while, but we have not found Copilot all that productive. So I think what we've seen is the best practice. Interested in your all's perspective on this too, in terms of AI, is you start with kind of internal evangelists and those who model good behavior, and then you kind of spread that through the organization informally. And from there, and we have this plan for an upcoming meeting to have people talk about their own use cases. So again, to kind of give examples, concrete examples to the rest of the team. And I think all else equal, the team is quite excited about kind of being set loose to use it more broadly. We still need to be respectful of kind of policy requirements about not utilizing proprietary and confidential information in any Gen AI engine or application. So until that's resolved, which we think is on the horizon, that will limit our usage.
We as a department did some fairly substantial trainings, both around information security, but also with OpenAI or ChatGPT as a tool to try to teach people advanced functionality. And I think that landed reasonably well, but it's certainly not fulsome. Kevin's point that this is so organic, how people are going to apply it to their individual roles. But I think we've done a good job of setting guardrails for particular use cases.
Yeah. We've not done anything in the agentic space yet. Obviously, we hear from our investment managers what they're doing. We recently did an outplacement of one of our analysts with an investment manager, an extended outplacement, and he was able to see firsthand how they're using agents inside of a multi-strat hedge fund. So again, that's going to be a learning he's going to bring back and educate the team on. In terms of the policy development, the ones in green are done, they're executed. So our travel policy is in place now. The insider personal trading policy that Bill presented on last quarter, that's been executed. And then in the HR space, our HR manual is pretty much through our operating committee, and so that'll get executed, as well as the rewards policy in June. The rewards policy bakes in all of our compensation related aspects, including the incentive plan. And we have had that reviewed by external counsel. It's going to go back to Mercer for a final look. And again, we expect that to be done in June. And then the final one where it says functional new agency setup, that's literally with Office of State Controller to create all the positions and the agency, the NCIA, as a new agency. And so we deferred that until July 1st of this year, just given other priorities and given the long lead time to work with OSC and OSBM to a certain extent as well. Okay, so I'm going to turn it over to Bill, and then Chris may chime in as well to give an update on the Compliance Risk and Ethics Committee, and those activities, kind of the CRE committee.
Thank you. As you guys may remember, we have established a Compliance Risk and Ethics Committee here at NCIA. The purpose really is to help develop, implement, and monitor our compliance and risk function here at NCIA. So think of it as a traditional compliance committee or risk committee at an investment management firm. We held our Q2 meeting 2 weeks ago. Some of the topics we discussed, which Kevin just alluded to, was the adoption of the insider trading policy. Along with that, we have engaged, or in the process of engaging, ACA compliance. We went out to RFP looking for some of the best compliance providers, and bottom line, they came out on top from a cost perspective, just a functionality perspective. They're going to support us on personal trading. So pre-clearance of trades, for example, managing the restricted list, managing conflicts walls, and the like. They're also going to support us just on conflicts generally. So business entertainment reporting, gift reporting, just the traditional compliance function you would think of. I'm really pleased that we've been able to bring them on board. I think it'll be a huge support for our compliance function here. I want to thank everybody for completing the state ethics training. That's a big deal. So thank you all. And then if you don't mind switching to the next slide on the compliance calendar, what we put together for you guys, and this is a work in progress, it will evolve over time by nature. And as we evolve over time, is a compliance calendar. And it's largely drawn from the board charter and statute. So in statute, you may recall there are certain reporting obligations that we as a team and the board are ultimately responsible for completing. We populated the different quarters with different requirements. Now, interestingly, the statutes don't provide a firm deadline within a year. So we have some flexibility when we do the reporting when we complete a matter. So for example, for Q2, the budget is here along with the annual report on salaries and bonuses. Again, these things could adjust and very well adjust over time. Ultimately, the CRE is responsible for monitoring this and making sure we are on task. We'll obviously work with the board to the extent we need anything from you guys and make sure we get reporting to you guys in a timely manner so that any forward reporting can be taken care of. And then one other thing to note before I turn it back to Kevin is insurance. As a standalone agency, we do have certain insurance requirements under state law. We've been working with the North Carolina Association of Insurance Agents. And just so you guys are aware, we've taken cyber liability coverage, but that's really under the department's cyber coverage, but we've been added as an additional insured. We've taken crime insurance and just a commercial umbrella insurance, which is required of all state agencies as well. And we work pretty closely with the state brokers to make sure that we have the adequate coverage and quite frankly, the coverage required in the law. That's a brief update. If you guys have any questions, please let me know.
Just wanted to offer, we view ACA at my firm.
Okay.
So to the extent that you ever want to speak with our compliance team on some of the ways in which we've utilized it, copy that.
That'd be great. Thank you so much. I will do that.
Okay. And then Matt, if you want to come up, if you recall from the from when we brought the investment policy statement to the board for approval for the North Carolina retirement systems, we reset benchmarks as the primary benchmark 6.5% annualized, the actuarial assumed return, and then a reference portfolio of 65% equities, global equities, and 35% to U.S. Treasuries with 5 years of maturity and beyond, right? And then we deferred approval, and it was delegated to the CIO to approve an implementation benchmark. We wanted to provide transparency to you all as to process we went through, where we settled, take feedback. If any of you are uncomfortable with kind of the benchmarks that we've chosen or the methodology. And then in future meetings, once this is kind of settled, we will add it to our quarterly reporting. We'll add it to our monthly reporting as well. So Matt Krim kind of took point on this, and he'll talk you through the kind of the recommendations that we've surfaced. Matt's been with us how many years now?
10 years now, a little over 10.
Matt is a director in risk and operations. So go ahead, Matt.
So if you recall, the investment policy statement had us do a reclassification of all of our investments to a new hierarchy, new taxonomy. We broke the portfolio apart between debt, equity, and multi-strat, and then had layers within each of those broader categories. And the IPS applied static weights at strategic nodes of the taxonomy. And then within those nodes, across the other asset classes, we have dynamic weights that will apply to the implementation benchmark. So as you think about how we've restructured the classification of the assets, we've recalculated performance by remapping all of the assets to these new categories. And back to inception of time, we're recalculating the performance of the portfolio. And as a result of that, we want to make sure that we have a benchmark for each slice of the portfolio that is also representative of the new structure of the portfolio. And if you want to flip to the next slide. Here's a high-level view of that benchmark. Equity, debt, multi-strategy. We have a 62% static weight to equity, same as our portfolio. 35% static weight to debt, and 3% static weight to multi-strategy. So on a monthly basis, we're going to recalculate the performance of the portfolio and the benchmark and apply these weights at those levels of the taxonomy for the benchmark to come up with the return at that level. However, the return for equity is going to be a function of the equity benchmark is going to be a function of the return of the underlying benchmarks for each of the asset classes within equity, and same for debt, and then for multi-strategy as well. Within equity, we have a 44% target to corporate equity. In our benchmark, that's a static weight that's going to be applied monthly, and then an 18% weight to real asset equity, static weight applied monthly. Within each of those categories, we have private equity and public equity within corporate equity. That's going to be weighted based on the amount of money we have invested in those strategies. So a dynamic asset weighting to come up with the return for corporate equity, which then gets weighted up into the return for equity in total. And same thing for the real asset equity. We have infrastructure and natural resources, and then real estate are both going to be asset weighted. We move over to the debt sleeve of the portfolio. We have three lower level sleeves: cash, credit, and investment grade. Cash is a 1% static weight by policy. Credit is a 9% static weight by policy, and investment grade is a 25% static weight. So each one of those sleeves has a benchmark applied to it and a benchmark return, and they're going to be weighted up monthly to arrive at the debt sleeve return. The multi-strategy, we have one benchmark for that. And we'll flip to the next slide, Kevin. Here's a review of the benchmarks we have chosen, the index providers or universe providers. And we tried to find a universe or index that is broad and measurable and representative of the strategy being implemented per our IPS. And public equity, we have the MSCI ACWI IMI Net as the benchmark, broad global benchmark. Investment grade fixed income, we have a custom benchmark, which is going to be the ICE B of A. We call it the H167, but it's a blend of 35% 5+ year investment grade corporates, 35% the mortgage master, which is agency mortgages, and 30% 5+ year treasury or government securities. Cash, you're using the ICE 3-month T-bill total return, and public real estate is going to be the FTSE EPRA NE REIT Global. On the private side, there's not an investable benchmark per se to represent private investments. We have MSCI Burgess Private Capital Universe of peer funds that we currently have a contract to, and we utilize quite a bit across our investment process. And so it was a natural fit to include them as a potential benchmark solution for us on our private side. We looked at Preqin, we looked at Cambridge, and felt that MSCI was a good solution. It's very broad, probably 15 trillion plus of assets in the universe across all strategies and thousands of funds in there. And so we can utilize that to get a good feel for the broad universe of each strategy. So private equity, we're using the MSCI Global Private Capital Equity Universe. and credit. As you can see there, the private capital credit universe for MSCI, and then infrastructure and natural resources is going to be a blend, not a static blend, just a composite of all the funds that are in the infrastructure and natural resources universe. And private real estate, we're going to use the Burgess Private Capital U.S. real estate universe to represent that space, and that's U.S. specific, given various drags on international real estate investments. And multi-strategy, we're using the Pivotal Path multi-strategy universe to represent the benchmark for that portfolio. Common question is, why not HFR as a benchmark for that space? We've looked at that. We have a contract with Pivotal Path now, and Ty uses it quite a lot within his manager searching and manager analysis. And it's a fairly new-ish provider of hedge fund peer returns, but it's institutional quality, a lot of funds. There's probably, I want to say $400+ billion of assets in there, 90+ funds within the multi-strat universe itself. So good representation across institutional quality, multi-strategy managers. HFR doesn't have a pure multi-strategy universe. They have the event-driven, they have a relative value. And so this one we thought was a more pure universe for that space. You want to hop to the next slide, Kevin?
Yeah, I think one comment to emphasize, we've been using Burgess for quite a long time in kind of the private space, the liquid space. And I think that there's been a concentration in the industry, a lot of crosswaves, obviously, in terms of the consolidation around data providers, benchmark providers, risk systems, and things like that. But Burgess seems to be as good as any. And there is a white paper that we included in the board materials in our appendix. And one of the things Matt did was to look at goodness of fit of each of these benchmarks relative to our performance historically, because we can't do it in the future, but we can at least look historically. And each of these were, a very good fit. Some like investment grade, that's been a longstanding customized index that we've had for that asset class, tying into our asset liability studies. But for the others as well on the private side, the fit was pretty good actually, historically.
Yep, and real quick, go ahead.
So just one kind of question, comment, experience. If we change, or if over time we're kind of morphing the asset allocation, we have found as we were kind of building out private portfolios, there's a level of maturity or immaturity on that side. And so I'm not saying that you should dynamically weight vintages or not, but you could have mismatch there between your kind of benchmark and what your portfolio actually is. It's just to be cognizant of that. I don't know that you.
It's a very material mismatch.
Yeah. We experience that as we're building portfolios for folks. And there's a difference between a 7-year-old portfolio and a 3-year-old portfolio.
Yeah, exactly. And given we had 8 years of limited consistent pacing, our mismatch is pretty significant. And we've looked at the mismatch by vintage. We're missed out on some really good vintage.
Yeah, you're at that 18, 17, 18.
Yeah, I mean, our portfolio is going to be.
I just think it's important to kind of note that and make sure you're aware of that. It'll be something that will be purely different.
But if I had to speculate, we're advantaged by that.
At some point, yes, after you get past J.
I think 2021, some of those vintages, to the extent we weren't as active, that could be a good thing.
Yeah.
Right. One other comment, then I'll turn it back to Matt, is I think it's important from the board's perspective and the team as well to recognize that what we're driving towards is something that is a third benchmark to be used at the total plan level. That is an industry standard type benchmark. But it's really more around trying to understand how individual asset classes are being implemented. But it's not the start and the finish of that, right? So if we really in the future do deep dives on asset classes and want to look at success or lack thereof, strengths, weaknesses, we need to have a much broader set of metrics that we look at, as well as qualitative measures, right? So IRRs, look at the vintage analysis, kind of deployment, DPI coming back, all of that stuff. And I think, again, there's a tendency to focus on we have a benchmark, and that benchmark is what we have to beat. But this is really just one of several, and the primary ones still have to be what the board has previously approved, which is the 6.5% for the retirement systems and then the reference portfolio.
I think, Kevin, I can just make a comment to add on to what you said. It's very importantly, just so which is like, our primary goal is 6.5. And then if we can't beat the publics, why are we illiquid if we can't beat the public benchmark, right? And I think a lot of institutions overthink benchmarking. None of this is perfect, so we should look at it from multiple angles, including things that are not on this page, as you said. It's a triangulation process. It's not perfect, and I think it's important that we don't look at it as like, this is the end all be all. There's some places do that, and that's not a good practice. That's not the approach that is existing, as you just shared, but I think that's important to emphasize.
I've got a couple questions for Matt, sort of in this similar vein. One would be with respect to the backfilling and the way in which you guys are going to link track records. Is there an industry standard there that you rely on, like a GIPS, or is there another one sort of within the pension system from your peer perspective? And maybe a related question, do any of your peers use Pivotal Path? It's just a question from an optics perspective, given that it is a little bit newer and less familiar. Just curious.
I believe there are a number that do use Pivotal Path, and we can pull those and send them over to you as well. But with regards to backfill, maybe this is a good transition to the next slide. So we, as I did mention, we are recalculating all the historical returns for each of the new sleeves of the, or all of the sleeves of the portfolio as assets have moved between, and we don't have any that are really the same as before. So we're going to recalculate from inception to forward monthly returns. And for the asset classes that have changed and sleeves of the portfolio that have changed, we're going to do the same thing for the benchmarks. If they haven't changed, for instance, think about public equity. That hasn't changed. Things may have moved in and moved out. A couple private investments may have moved to private equity, but the structure and the strategy is still the same. So we're going to keep MSCI equity. Historically, what was in our system is going to stay in our system. Same thing for private equity. It's really the same. And we've had a private equity benchmark historically that was representative of our strategy that was in place at that point in time. And so it's fair to keep that in place going forward and cut over on March 2026 after the IPS was approved in February. Returns from there on out will be based on the new index. The total implementation benchmark historical return is going to be what it was, because that's, again, reflective of what our strategy was at that point in time and how the portfolio was implemented. So total will be the historical time series that was earned by the benchmarks in time through February. Going forward is going to be a function of the new benchmarks and the new weights. It's going to chain link those together to come up with a time series of returns for the implementation benchmark. What that does is it creates an inconsistency if you're going to do some attribution analysis based on portfolio weights, because our historical weights are on asset classes that may not exist going forward. So you can't really do the allocation selection effects on our new asset class taxonomy because it didn't exist. So we'll have to get creative on how we evaluate allocation decisions over a period that extends prior to February 2026. But looking at the screen, we have on the first bullet points, buckets that are going to change are total equity, real asset equity, infrastructure, natural resources equity, debt, investment grade fixed income. Because either that sleeve didn't exist or a sleeve underneath of it is new or has a new structure to it. So it's the weighted return of the underlying sleeves of the benchmark that drive that return. So we're going to retroactively calculate those. The calculation methodology should be consistent with GIPS, using a modified dates methodology on a monthly basis going back in time. To the extent the cash flow in or out of an account is greater than, I think it's 7% is our threshold, then they'll convert it to a daily time-weighted return calculation to the extent they have daily valuations. Most of the accounts don't have daily valuations because they're privates or funds that report monthly. So in those situations, there'll still be the modified Teets method, but those will be backfilled accordingly. On a go-forward basis, we're going to calculate returns. When we close our books monthly, valuations, everything gets a value in our portfolio monthly. For assets that don't have a new reported valuation for the prior month end, it's going to be the cash flow adjusted valuation from the last reported valuation. So once those are done, about the 10th business day or so, performance is going to start calculating on our portfolio and then on our benchmark as well. A little nuance with the way that we assign a return for benchmarks that don't report monthly is that we will use our portfolio return for the months when they don't report. So first and second month of a quarter, private markets aren't going to have a return for the prior quarter. Their returns usually show up on the last month of the quarter for the benchmark. So first and second month of the quarter is going to be the portfolio return. The third month return of the quarter is going to be a plug that sets the 3-month return equal to what the index provider provided. So when you're looking at returns on a monthly basis, there might be a lot of noise around. You might see our performance report where it says, how did private equity earn the exact same thing as the benchmark 2 months in a row? How is that possible? It's just a nuance with the calculation. I think it's the best we can do in terms of closing our books monthly and assigning a valuation to the portfolio and a benchmark return to have a monthly return series. And I think there could be an approach where you leave your books open for a certain amount of time and then wait for the valuations to come in, but then you really never have obviously you don't have a closed return stream until months later, quarters later, and it's constantly changing. So we've elected to close the books monthly and close our benchmarks monthly as well. And you probably see that when you're getting your monthly report from us, it's quite lagged. Sometimes it's into the next month or 40 days later than when the period ended. And that's largely driven by the benchmark returns because the benchmarks are waiting on MSCI to come in or HFRX currently or HFRI currently to come in. And so we can't publish that until those come in. If you want to flip to the next slide, if there's no questions.
And then one thing to state, just so it's abundantly clear, the restatements, recalculations of historic returns that Matt was referring to, none of it touches the total plan, right? So that history is there for all time. And we have this high degree of sensitivity around having those total plan numbers move around, due to restatements, revisions, and things like that. So we think particularly in the public sector for a public pension fund, we need to have heightened sensitivity around that. So that's why we like to lock it down and not just leave it open and have restatements and things like that, because things will change then around key reporting time periods, end of calendar year, end of fiscal year. And it's just not worth the headache, frankly.
Then there's a trade-off, right, with locking it down for the benchmarks before the entire universe reports. Oftentimes with HFR or Pivotal Path, you're going to get initial preliminary returns throughout the month for the prior month. And probably going to have 70, 80% of the value of the funds in that universe report by the time we grab our return. So the return we put in our books for these indices, mainly the hedge fund indices, is not going to be matching what is ultimately the return of the index that they publish. So there'll be that noise there. Here's a table of all of the details associated with what we were discussing. So if you need to fall asleep quickly at night, you can pull this out and take a look at it, but it really just hits on kind of all the levels of the portfolio and the benchmark and how they're going to roll up in the ultimate calculation of various sleeves of the benchmark, how they're weighted, how they're backfilled. You can see there's not many that are backfilled there.
Do you know off the top of your head, or maybe Craig knows, in the MSCI Global Private Equity benchmark, the underlying weights of LBOs to venture capital?
I want to say it was, this is off the top of my head, I think it's about 2/3 of the value is LBO, the remainder to private venture capital-ish type strategy, expansion capital.
Sounds about right. I don't know the exact numbers, but skewed more toward buyout.
Have you thought about just doing the two individual at whatever rates that you guys put capital to work? Like we don't roll up to Burgess Private Equity. We just use Burgess Buyout and Burgess Venture.
So this is just what impacts the implementation benchmark here. There's going to be another level for private equity, which is going to be buyout and venture and growth. And then venture and growth, we have early stage, late stage, expansion capital. And so we'll have benchmarks for each of those to look at the performance, but it's just not going to roll up into the total implementation benchmark. And we'll probably have some sort of dashboard where we show our portfolio relative to all of these different underlying benchmarks as well.
And this is a concept out as a waterfall throughout the whole benchmarking. This implementation benchmark is we want to get to fixed weights as we get through the transition. And so, we're leaning heavily into venture capital and growth to not to the total exclusion, but to the kind of deprioritization of LBOs or being highly selective, right? And, we want to have that generic benchmark to be able to see, what the return impact of that is, of that strategy of leading into venture capital and growth at this point. It's not to hold the team necessarily accountable, the private equity team, to that allocation. That's kind of a shared responsibility, but we think it should at least be measured so that after the fact, we can look at whether it worked or not and understand why.
You won't even be here when you say that. But I love the philosophy. Well, eventually, we'll all not be here when you figure out if that worked, but.
Sometimes they happen fast.
True. You'll have the same issue, right, with infra and natural resources, right? Because
Yeah.
you're going to have different weights relative to what the universal sector.
Potentially for debt too.
Well, that one, on the investment grade side, though, they did what I call Franken benchmark. And they actually, they did the 35-35-30 thing.
And that's been there for years and years. And it really does tie back to the asset liability study.
Yeah.
Where we looked at this type of longer duration, which I think is running about 8.2, something like that these days, relative to an off-the-shelf ag or intermediate ag.
I really meant the private credit.
Yeah, sorry.
No worries.
And to be clear on this table here, you see investment grade, and then all the way to the far right, returns prior to March 2026, it says new backfill. It's not really a new backfill. This is a modified sleeve of the portfolio where we used to have a 10% slug of cash in investment grade fixed income as a way to shorten the duration with our core fixed income portfolio. That benchmark there has always been the benchmark for core fixed income. When we redid the structure of our portfolio, we removed that 10% slug of cash and put it in the cash line item. So now this is the same benchmark that was there before for core fixed income. It's just now getting mapped to the investment grade sleeve. Questions?
Okay, can I just note one other thing? When we say we're recalculating all these sleeves, we're having our master custodian.
I was going to ask.
So it's, we're not doing it ourselves. We put processes in place to check and make sure that they're doing it right. But we do have a third party doing that. Just want to make sure that that's clear.
So noted. A good clarification. Thank you.
Then going into the performance reviews, and this will probably be a bit abbreviated. So our assets under management are well north of 200 billion. And this is through March. All of our reporting today, so we know there was a pretty significant change in market tone and post March 31st. So if you want to talk about where our estimated performance is.
Yeah, so calendar year to date, we're currently at up about 4.5%, up about 6% for the quarter. So you see that the Q1 numbers were down slightly, about 1.3%. So and then I think the CRS portfolio hit 148 billion for the first time today or through yesterday. So obviously it's a bit higher than we're showing here.
Same for the supplemental retirement plan. That was north of 20 billion, I think, last we looked. So Jeff and Ty are at the table to talk about our kind of summarized view of macro markets. And, so go ahead.
All right, I'll kick it off. Ty Powers, I work on our multi-strategy team. I'll go over a handful of the macro items first, and then kick it over to Jeff to pick up on inflation, labor numbers, and then how that impacts Fed decision-making, ultimately rates. And then we'll flip that over to the markets and the impact there, and wrap it up, and then pass it back to Kevin for updates on how we're positioned across the portfolio. So taking that from the top, resilient U.S. growth is kind of an understatement. We're almost fully through Q1 earnings for the S&P 500 here. Couple of notable items: over 80% of S&P 500 companies have beat their earnings estimates. Not really a monumental task. I mean, companies are very good at managing the street these days. What I thought was more notable was that Q1 showed earnings growth of 27% and revenue growth of 11%. On top of that, margins expanded. So right now the average is about just under 15% net profit margin, and that's way above the 5-year average, about 12%. So growth is solid. 2026 full year estimates are still tracking kind of in the mid to high teens. Some analysts have them upwards of 20% year over year. So all told, corporate activity, corporate profitability, really, really strong. On the flip side, consumer sentiment. We just printed the lowest consumer sentiment number. This is University of Michigan Consumer Sentiment Index of 44.8. That's the lowest ever since the survey began in the 1950s. So definitely skewing more towards that lower end of the consumer, lower households. I would note back in COVID, consumer sentiment, that index dropped all the way down to 71. So remember back to COVID, I kind of thought we were probably at the same level at this point, not even close. So that on top of increased auto loan delinquencies, definitely pinched on the lower end of the consumer. Credit card delinquencies are pretty stable. They're okay. But savings rates have been coming down. So definitely seeing that K-shaped economy manifest itself in a lot of the numbers, and that just continues. The big driver of a lot of the corporate profits is AI-related capital expenditures. Major support for investment activity and as well as earnings, these earnings beats. For 2026, I think the estimate right now is about $750 billion plus in CapEx spending by just the big hyperscalers and some others globally. Just to give you an idea, that number has tripled just in 2 years. So a huge boom in CapEx super cycle here. So that kind of brings me down to the last one, the base case. Economic expansion continuing. Profitability is good. Corporate profitability, that is. But Jeff will hit on this in a second. The policy room is really narrowing because of inflation impacts from the war, but also some of the impacts on the lower end of the consumer, as well as some of the labor dynamics that we're seeing there. And Jeff will hit on some of that.
I think what's interesting is that the spending gets held up pretty well despite all the sentiment being pretty poor. So we'll see which way it swings. But so on the inflation front, obviously we've seen a reacceleration in inflation driven by the delay in resolution of the conflict, which tomorrow will be 3 months since the war excursion, pick your term, on that one. But it's the clock has turned pretty quick on that one. Labor market data has stabilized. That was a big focus kind of going into it. Potentially maybe a little softer underneath the headline numbers. But as a whole, it's stabilized and it's allowed that shift, I think, more towards the focus on inflation. The Fed backdrop has really moved from a focus on talking about holds and cuts and dissensions in the votes to the futures market showing a 75% chance of a hike now by the end of the year. So a dramatic change from what we were when we signed the room 3 months ago when you were talking about that. The worst confirmation now done, but not without a lot of interesting pieces to it in my book, and plenty more drama to come. Historically, in the recent history, you typically had the confirmation be done at the Federal Reserve as a vow to really the independence. And this time it was not. It was done at the White House, which is interesting, different take on it. And you've got Powell staying on for now. We'll see how long. One of the more interesting ones I thought was Christopher Waller, who was a candidate before for that type of job, and who certainly has been in full dove mode, dissenting and voting for decreases. And what if it was a sports moment? Would it be the equivalent of taking off one hat at the draft or commitment day and putting on a Hawks cap? The day of the confirmation, he made a speech in Germany and said the easing bias needs to be removed, and the next move could just as likely be a hike. So if I was a Warriors, I'd be like, wait a minute, I thought he was kind of on the side of certainly where administration would like things to go on it. So that was an interesting note too. And then the fiscal backdrop and pressures that we have from a growing deficit that are going to be where on rates are. We've certainly got defense spending strains on the deficit going forward. I think that complicates the desire to shrink the balance sheet. And hoping some bank deregulation can offset that. But I think it's, without putting pressure on rates, it's going to be difficult to shrink that balance sheet in the near term at all. So I think that will definitely be a long-term game as a whole. Flipping over to kind of the market impact of all that macro backdrop, we've seen rates under pressure as global inflation concerns over that delayed resolution there hits the 30-year, hit the highest level in nearly 20 years. We've come back inside of that about 20 basis points now. I think pretty much 5 days in a row, we've kind of come back and track on it. The real head scratcher for me that with what's going on is credit spreads still remain at historically tight levels. Investment grades one off the floor, recent floor, right? And high yields only 15 basis points off. So maybe those things just don't mesh very well together with what's going on. But I think a lot of that is a reflection of demand is still strong. The absolute number on those is strong with the backup in rates that we've had relative to what's been in recent history, where we went a decade there not seeing 5% handles on the broad investment grade index. So I think that's creating some of that as well too. Taking a look at kind of the expectations on the markets piece going forward, the bond yield forecast, which Bloomberg does monthly, got updated last week. And there was, I think, 39 responses this past week on it. Only 4 of the responses had the long bond higher from the current rate by year end. I thought it'd probably be a little bit higher than that, but I think it really showed as a whole the consensus from that group, and it's a pretty broad group, thinks that, to me, it tells me that there's going to be resolution here at some point. I think the calendar of being midterms is further increasing the pressure around that. We'll see what the resolution looks like. But I think that really is kind of, to me, the underlying tone of the market is they're going to have to reach something that should at least start to take some of that pressure off at the end of the day on it. Having said that, we're 3 months in, so at the end of the day. As far as real rates, we've really been, for the last 3 to 4 years, in a 175 to 2.25 range. 10 years about 215, 216 in there. So we're still within that range. We've seen real rates, peak up a little bit with that number too. So something to keep an eye on.
Yeah, on the equity side, I mean, all-time highs every day. So that just continues to run. Some of the internal dynamics underneath the indices are somewhat more interesting. We have seen a little bit of rotation, not necessarily in outright leadership, but we've seen a lot of the more energy and infrastructure specific cyclicals really do well this year. And a lot of that is obviously from the war and the impacts there. But below that, small and mid caps have done really well year to date. So we're seeing some nice, kind of breadth across the equity markets, which is encouraging for maybe this run to maybe continue, but it's not without its risks out there. So energy markets and the impact on oil from the Strait of Hormuz closure, I mean, that's really the macro market focus.
and has been for the last 3 months. It's kind of fits and starts, like just peace deals, no peace deals, memorandums of understanding. We kind of go back and forth, and the market kind of has actually been really resilient through a lot of that noise. And I would, even the VIX, I think it spiked above 30, closed above 30 on one day since the war started, which is pretty remarkable. Just from the amount of headlines and geopolitical risks. And as that relates to kind of developed ex-US, so international stocks versus domestic, you heard me before on the growth prospects and what's going on domestically. It's tough for us to shy away from that given the tailwinds. And notably earlier this year, we were a lot more constructive on international equities. That kind of shifted with the Iran war. I think the impacts from the energy disruption, inflation impacts, particularly in UK, Europe, and even down to Asia, and then the supply disruptions will impact their economies more than ours potentially. So we're a little bit more cautious, international versus domestic, and that'll remain to be seen how the impacts of the strait being closed kind of funnel down to those economies. So it's kind of where we are right now. And you got to.
The other thing I'll throw in was the expectations for inflation going in. If you take a look at break-even rates from the TIPS market, 5-year break-evens have come down 270s to 250s range. So we've seen that kind of retrace here a little bit. And the 2-year was up at like 330 for a little while. And we're back to 260 there. So I think it's kind of signaling the same thing. They think that, that we're going to move towards some kind of a resolution. It's a little bit of an aggressive move, I think, on the 2-year, but it's certainly come in some.
Yeah. One last note on the strait. After all the news over the weekend about the strait reopening, I've been checking the live updates on Bloomberg. So yesterday, 3 tankers got through, 7 cargo ships. So it's getting better, but way off the 100+ kind of ships that move through there on a daily basis. So hopefully that improves, which will alleviate some of the potential pressures on international markets going forward. But again, a lot of uncertainty there.
Yeah, so the primary tensions that we're grappling with are in this kind of middle column, the risk opportunity set is, on one hand, almost boom-like conditions in some ways in the US, given the tax changes, the AI build-out, earnings growth. As Ty noted, if you move away from the Mag 7 year-on-year earnings, I think earnings per share were up about 17%. So it's really broadened. But then we have the geopolitical stress, which I think our normal approach to that is to look through it and not try to read too much into it. This time we took a more nuanced approach, which I'll show you how we actually reallocated in March and in April. And the long-term bond yields to a certain level, if they get to, that's a problem for the equity markets, right? We just know traditionally that's been a key trigger. So, and then the whole issue of inflation and the negative shock that's hitting Europe and Asia from the Middle East conflict. So the areas that we've liked are listed infra, natural resources, REITs, multi-strategy, and similar to what we've talked about before, shorter duration, higher yielding commercial real estate loans and securities, and then less attractive international equities because of the negative economic shock, duration. So Jeff is responsible with his team in terms of managing the duration within the investment grade portfolio, but at the total plan level, we're fairly long duration relative to our reference portfolio, right? That reference portfolio is just treasuries 5 years and longer. So our kind of normal portfolio is longer than that duration wise. So I'm going to jump forward to actually show you what type of rebalancing activities occurred since the February meeting. So this is slide 12. People are following along. I think it was essentially two activities in March and in April. Didn't all happen at once, but what we did is we sourced monies from the left-hand side. So we pulled $1 billion down out of the investment grade portfolio because of concerns around inflation and the term premium. We pulled $3 billion from international equities. BlackRock, that's an index fund. And then Walter Scott, we also had some performance issues with Walter Scott, so we pulled them down. And then we terminated Brown for performance reasons and organizational reasons. And then utilized $1.1 billion of available cash. And we directed that towards, in the first row is Gladius ARCs. So that is a fund of one hedge fund strategy that is there to protect against downdrafts in equity markets. So if equity markets go down 10%, then we would expect that portfolio to produce a return of say 2 to 4%. Is that fair?
Higher.
A little higher, aspirationally. They monetize quickly. It's weekly liquid. So we use this to hedge some of the risks that we saw coming out of the Middle East and the elevated kind of status of equity markets. And then there's quite a few multi-strategy funds, Balyasny, Brevin, those were in place, and so those were top-ups. And there we felt that they would be in a position to take advantage of any dislocation and dispersion across markets very broadly. Brevin Howard is a relative value macro, and Balyasny Atlas is kind of a standard multi-strategy. Broadreach is a emerging market hedge fund, global macro. That's a new relationship. And then in light of what we expected to be broadening kind of participation in earnings and profitability of small cap, we added $540 million to small cap, and then that helped offset the defunding of Brown as well. And then we topped up what we call staging portfolios, or created staging portfolios is maybe a better way for the real assets side of things. So for real estate, we had an existing developed market REIT portfolio with BlackRock. So we added $1.5 billion there. And then on the infra and natural resources, Andy Hoffman, the head of real assets, worked with the public equity team, namely Greg Taylor, who you'll meet a little bit later, to create an internal portfolio to get the exposures that we think line up reasonably well with the kind of broader infra and natural resources private market. And then there are some views around sectors as well. So the idea was we really don't want to pull down our public equity exposure net. We still are quite constructive, particularly on the US markets. But real assets were significantly underweight. And this is our status as of May 14. And we believe that if we fund up liquid real estate REITs, liquid infra natural resources, that they'll participate to a certain extent in equity market gains, to a lesser extent in declines. There's some interest rate sensitivity, so we're not ignoring that. But to the extent there's inflation, the whole real asset space has caught a bid in the public markets. So we think that's supportive. So again, we've taken what we feel are some tactical positioning on the margin in light of what happened in the Middle East, but we really don't want to drift too far away from what we still see as a strong and constructive equity market outlook. The big challenge will be if there continue to be higher yields on the long end, that can certainly create some competition for capital. It could create some questions about the valuations in the equity markets. So we need to be sensitive to that. I can't predict we're ever going to get the timing right, but that certainly is top of mind for us. So anyways, I'll pause there. If there's any questions around how we've approached the current market and rebalancing.
Hey, Kevin, a comment and then maybe a quick question. And you guys are probably aware of this. I was just reading a report this morning that Goldman put out. So the equal weight S&P is flat over the last 3 months. So as much as we talk about broadening, right, the average stock in the S&P hasn't had a return. And 80% earnings growth so far this year is from AI infrastructure, right? So we're not, it's interesting, like you're seeing a broadening, but I want to just point that out, make sure we're aware of it. Granted, we're long-term investors, but the questions I had were, with the small cap, how did you think about S&P versus Russell? Because there's big differences there in those indices. And then why global REITs versus just US REITs?
Yeah, okay. So with the, on the domestic side, our orientation is towards the Russell family. And that's what we implement internally, the Russell 1000 Index Fund. And then the Russell 2 for the small cap is just much more broadly followed. So there's better liquidity in the ETF. There's a fair bit of hedging demand as well. So there's securities lending income on that. So that's how we've approached it. We haven't really gone much beyond, Greg, you can correct me if I'm wrong, kind of the Russell family in terms of our orientation on the public equity side.
Yeah, the ETF, one of the IWM kind of the size we were looking for.
Because, and you're probably aware, that's part of why I asked that question, Kevin, is the S&P screens out all the money-losing companies. And so it does make, over time, there's a delta, something to be aware of.
In terms of the kind of the REIT space, we have the potential to implement a U.S. REIT portfolio internally. But again, our longstanding approach has been to be very diversified in the REIT space. And the one gap we have at the moment, which we're working on, is we don't have much in the way of emerging market REITs, which is a pretty strong diversifier for the global REITs. We've been more focused on kind of world than not, developed market, not the emerging. But our view is for these staging portfolios to be, quite broadly diversified, given that the opportunity set is global.
Kevin, I just have a
Yep.
question on Gladius. It's probably more of a philosophical question on internal direct hedging relative to when you would put that exposure on through a manager. Just curious, sort of the thought process there, given your internal capability.
Well, our internal capabilities are non-existent in terms of hedging. Just to be very blunt, that's something we want to fix. So we don't trade futures internally. We don't do total return swaps. We don't have ISDAs. We've had various components of those kind of infrastructure in the past, but we don't currently.
Okay.
So that is.
swap lines.
Pardon me?
There's swap lines.
No.
But that's in the mix.
Yes, exactly.
Okay, perfect.
Good. Yeah, and there's multiple ways. Ty's been doing some research on this, and as well as how we might implement, and there's some personnel aspects as well. But the Gladius is a long-standing relationship we've had maybe since 2011. Small manager in terms of asset size, very customized in terms of what they do. We've long had this rebalancing product relationship, which is an options-based strategy on top of futures and cash. That's largely being utilized to build out multi-strategy. So we're pulling that down over time. And then ARX is a relationship we've had, I don't know how long now.
Since 2016. And ARX is a little nuanced versus just going out and buying puts. Because we were cognizant we didn't want to burn option premium while the markets grind higher, because that's an easy way to lose a lot of money over time. So there actually three components. So you get your convexity through some of those long options, long downside options, but then offset with some relative value and carry trades. And they do that, index versus single name. So very actively managed to offset a lot of that convexity that they're buying with the hope of not burning all that premium. The downside is we don't catch the down 3 to 5% moves. So our attachment point is a little bit deeper, but when the market does move, 10, 15, 20, that's when it really kicks in. But we're also not giving up 2% in performance every month.
Thank you.
Okay, I'm going to step through our new commitments. So in public equity, we did a co-investment in, I guess, defense tech is the best way to describe that. The private equity, we did a single asset continuation vehicle with Providence. That's Y Combinator. So this is a new relationship for us and across 3 different early stage strategies. We've got good capacity with them. We're very happy and continue to be happy.
I believe I have it correct that we're the first public pension plan that they've ever accepted as an investment.
We can follow up. That may be true.
It's just a huge credit to the team here. That's good. Top tier venture capital has not been the province of pension plans historically, and we're having to break into that set of managers, and this team's done a fantastic job.
On the real estate front, I've already mentioned the REIT addition, and then the net lease. So that's a relationship, a fund strategy we've pursued in the past. We'll have an SMA as well. So these are basically single owner occupied, largely industrial, non-investment grade leases. And then this NCRED B with Benefit Street Partners, that's a top up with them in addition to, I think we did about $1 billion or so, a little bit north of that for commercial real estate mortgages, whole loans, and this would include some more opportunistic things around CMBS. And then quite a bit of activity in the infrastructure and natural resources space. So we've got 3 commitments we've made with ArcLight, longstanding manager, both 2 funds, and then the SMA. The thing to note for the SMA is that's an opt-out structure. So that's kind of our preferred structure at the moment, where we'll do a commitment to a fund or funds within a complex, and then we'll agree preferred terms for the SMA, and then every deal we have the ability to opt out. So it's a way to control pacing, and it evidences strong commitment and conviction with the manager. But we do get to control our destiny. It does create a burden. We need to do the underwriting, and we need to move in deal time. So we might get, if it's in the private space, we might get 10 days. We'll see early teasers, but that decision needs to be made ultimately in about 10 days and then funded. And we're doing some on the multi-strat side as well. There, the turnaround is much shorter. And then the real asset staging portfolio, I mentioned that. Then in multi-strategy, some of these I already touched on in that rebalancing. We've also added some money to TPG, AG, Catalucci. That's more credit oriented. It had been a multi-strat. It's evolved more towards credit. And then Castle Hook is a new relationship, and we have a relationship with Dean, which is an options-oriented global macro manager where we can do co-investments. So we've done one of those so far. Terminated Brown, so I mentioned that already. And then our pipeline, I'm not going to cover this. It remains extremely rich and diverse across all of the asset classes.
Question on our prior page. On the internal real asset staging portfolio, how did you guys develop that? What was you kind of used to develop that or kind of created?
It was really kind of dual. And there's an external manager that we've used to do some modeling as well, which we may also fund as an additional staging portfolio. But it was really doing internal analytics within the real assets team and then bouncing that off of our public equity team in terms of liquidity, ability to transact. And then the real assets team was responsible for looking at the various exposures that they wanted, available instrument set, all cash market, and then the public equity team looked at that. But the idea was to try to line up with one of the private market infra natural resources benchmarks similar to what Matt was talking about, MSCI or
Rough number count
in terms of the
of positions in there. Rough. 185. We pared it down.
Okay.
Hey, Kevin, quick question. How are you all, and this may be for later for Craig, but how are you all thinking about pacing, commitment pacing? Obviously we got tons of liquidity now, but I'm thinking out, in the future.
Yeah. So again, to be very transparent, I've been telling the team at this moment in time, let's focus on quality deal flow and using SMAs where we can have that ability to opt out if we want and not try to get tied down with multi-year pacing plans. I think at this moment in time, particularly 25, still in early 26, it's been a really tough fundraising environment. So the value of our capital, particularly at the size that we're committing, is quite high. And so we want to take advantage of that. I don't want to have the teams focused on trying to fill buckets of we'll do $1.5 billion this year and $1.5 billion next year and so on and fill up the buckets. So I'm happy to get redirected on this from the board, but I think at this juncture, we should be leaning into certain exposures, de-emphasizing others, be less focused on kind of the overall pacing. But as these monies get put to work, that we've committed to in the last year and a half, then we'll be doing pacing plans. Right. But at this moment, I didn't want to set a pacing plan. If you remember when you were on the IAC, and we were thinking about what are we going to do with all this excess cash, I was very uncomfortable with trying to put together a pacing plan because I want to be much more kind of market oriented in terms of the opportunities.
Right. So I agree with that approach. There's more cyclicality in illiquids than I think is fully appreciated, and we're in a unique environment today, so you should take advantage of it.
Where that manifests, I know Craig put on in his presentation, it's really in tech and PC right now. Capacity that's come available, more cyclicality that's evident in the AI cycle. And so we're really thinking about that, but I don't want to steal their thunder. I may just have.
So performance, I'm just going to have a couple of words on this because again, it's already out of date since it's end of March and we were up significantly through middle of May. I did want to show our first kind of attempt to build out new attribution. And so again, I'll just kind of walk through at a very high level. What we're thinking is we'll have attribution in the future that will cover versus the actual rate of return. And then the reference portfolio and then the implementation. We're not going to grind through those every meeting, but for asset class attribution versus the 6.5%, we're essentially, you can see in this 1 year time period, it's really an equity story, right? So with equity markets up about 19% for that year, and then you look at our allocation to public equity out of the 11% that we produced at the total plan level, 5 percentage points of that is really coming from equities. And the net kind of increment over the 6.5%, 5.28% is coming from equity. So it's really an equity story for that timeframe. We have the 3-year numbers as well. I've broken these up a little bit so they're more readable compared to what we distributed. And the story is a bit different, but still it's really, even for a 3-year time period, really dominated by the public equity story. That's where the returns have been. And investment grade fixed income there with the rise in rates, the return was 3.6% versus the 6.5%. So then when you take that as a share of the total plan, that deducted 82 basis points. So net across all the different sources, you can see that we were still above the 6.5 by about 187 basis points. So that type of attribution, I think we'll have to grow into over time as, we're comparing ourselves against an absolute return. But since it is the primary benchmark, we'll continue to do that. The attribution versus the reference portfolio benchmark, this is a bit more traditional because we have benchmarks historically for these asset classes as well as the components of the reference portfolio. This one is a lot more complicated to kind of understand because we have a reference portfolio that was in place for 11 months, and then it was changed with the adoption of the new investment policy statement for that 1 month. So we do get some oddities, which I'm going to make Matt explain. Some of these are straightforward. So like public equities, we're significantly underweight public equity relative to this reference portfolio concept because the reference portfolio weight is almost 58%. We're at 43% for the 1-year average allocation, and we were allocated to private equity, non-core real estate, and credit, right? Those are all kind of in that bucket. And so by being underweight public equity, that had a negative allocation effect. And then we also underperformed our benchmark. So that gave us a negative selection and interaction effect. So the total effect here was negative for public equity overall. Investment grade, that actually was a significant favorable offset as well as inflation sensitive. Inflation sensitive, though, is where it's a bit wonky because we have a 1-month effect. Do you want to try to summarize that?
Sure.
10 words or less?
So this attribution is calculated on a monthly basis. If you think about the allocation effect, it's the benchmark weight multiplied by that benchmark's Steve's return minus the total benchmark return. So this looks weird because you have, for inflation sensitive, the benchmark earned 20.37% for that month, and we were underweight. I mean, for the year, we were underweight. If you look at the average weights there, by 4% for the year. So you think we underweighted an asset class that significantly outperformed the total benchmark of 12.89%. That should be a negative allocation effect. As Kevin mentioned, for 11 months out of the year, we were underweight. The 12th month in March, we were overweight because commodities and inflation got removed from our long-term policy reference portfolio, and they had a fantastic month that month. I think they outperformed the benchmark in March by 12%. And so we were overweight inflation for 1 month on an asset class that earned 12% more than the full benchmark. It gave us pretty much all of that allocation effect, a large portion of the allocation effect for that month. So those weights are average weights, and if you have big changes, it's going to create a story that doesn't hold over the entire period.
So there will be some challenges in the near term because we've changed the structure, we've changed the benchmark, but we'll have the information on the attribution in. We'll do 1, 3, and 5-year time periods. So just wanted to, and then on the
just before you move forward, and maybe this takes work off your plate, I don't know. I'm just curious about why you would do attribution at the actuarial rate level. It's always going to be at a 6.5 equity dominant until It's not. I mean, I'm wondering from a stakeholder perspective, why we do that.
Yeah, I think the reason we do it is that ultimately, we have stakeholders that go lecturing or mansplaining, but way outside the room, right?
Right.
That care mostly about that 6.5%.
Yeah.
All the other stuff we do, beating the reference portfolio or the implementation benchmark, all the kind of other wins or losses we might have, nobody cares.
Yeah.
To be blunt, right? It's just that 6.5. Are we delivering that over time? So the challenge we have is we want to kind of change the mindset of the process, the team, to be more focused on this absolute return ethos. But there's so much noise in the short run. And I think what you're getting at is it's also quite binary, right? It's did equities do well? Did bonds do well? And the rest of the portfolio doesn't have that big of a contribution at this point.
I'm just wondering about the framework and whether that's actually accomplishing what you're trying to accomplish. That's more what I'm puzzling
Open to
over.
other approaches for
Because I
sure.
understand completely that we have to demonstrate
Yeah.
some sort of analysis around how the portfolio did relative to that number. This just doesn't tell me that. If anything, I would want to look at like, what's the expected return on these different asset classes and how it rolls up in a weight to a 6.5, and then
Yeah.
how assets are doing relative to that long-term average, right? And then I'm spitballing. You guys are way smarter than I am about figuring out another way to
So that
demonstrate that.
that notion of looking at returns versus expected returns that were baked into the, say, the asset liability study.
Yeah,
So that was one thought we had.
Yep.
I
but is that too complicated for just a
don't think it's
layperson?
too complicated for the
Okay.
board, right?
Yeah.
I think you all would probably be able to utilize that in understanding what we're doing and
Yeah.
so on. Now, our expectations over time on returns and risk for the different asset classes will morph, but that's also the kind of thing that we could give more visibility towards.
That's a thought.
That's a good thought, yeah.
Maybe piling on, just because I think about existential threats to this whole architecture
Yeah.
all the time. And managing those is, I think, my primary job. The 6.5% is the existential threat. If we cannot deliver the actuarial return over long periods of time, and that's where I think this is imperfect right now. We're showing 1 and 3. We should be showing 5 and 10, and we will get there as the portfolio matures into that. Every asset class, except for long duration fixed income and cash, should deliver 6.5% over those long periods of time. Otherwise, what are we doing? That's a great fixed income and cash have different roles. They should perform differently. And so we've got to hold ourselves to account on every asset class over and over again, so that we never lose sight of, again, the big existential threat.
So that's what you like about showing it in this.
Very
way.
much.
Yeah.
And I know it's imperfect,
Okay.
but it is our North Star.
Mhm.
And I think you raised an important point, Brad, which is like when I look at this and I see 1 and 3 years, like it's kind of irrelevant, but I know it's important. Like we really need to focus on 5 and 10 years because that's where real value creation, and that's our advantage too as a business system. Right? So I know in general in the investment industry, people like to focus on short term, but that creates a lot of the imperfections and issues.
Yeah. So the counterweight I feel though is been emphasizing that we want to improve performance on the retirement systems materially and expeditiously, right? And because we have gone through long periods of time where the risk posture was not sufficient to get to 6.5 or whatever the actuarial return was. So to a certain extent, we want to be held accountable that we are trying to improve the performance. But by the same token, the measurement period is too short to be meaningful, right? So there's this kind of tension I feel around the topic. And we also don't want to fall into the, we want to be very focused on the long term, but also don't want to just say, don't worry, it'll all work out.
It's almost like a path of progress. I mean,
Yeah.
10s are made up of a bunch of 1s.
Okay. I think I'm going to actually stop here on the performance presentation. I think we've hit the main. I appreciate everybody's questions and feedback on this. So we have private equity is up next. the review of the asset class.
That's right.
So we have the private equity team. I'll let them introduce themselves. And we have two asset classes. And again, if things run a little bit long, I don't think we'll be using all the allotted time for the strategic planning discussion and the budget. So I would encourage interactive presentation and discussion. So go ahead.
Thank you, Kevin. So for the benefit of those that are participating virtually, Craig Demko, I'm the Director of Private Equity, and I just want to take a few minutes to introduce the team. As I was pulling together my thoughts yesterday on the presentation, something kind of jumped off the page at me, and it's the amount of years of experience this team at the table has. So in aggregate, we're almost 90 years of investment experience. And specifically, when we just look at private equity, we're at 57 years now. So myself, I've been with the plan for 21 years, fully focused on private equity and similar asset classes. Brian Bolkart, excuse me, who sits two to my right, he has 20 years of PE experience. He was with us for about 10 years now, when another 11, and the remainder was with Virginia. And then a new addition to the team, Ben Peterman. He's been with us for almost a year now, and he has 13 years of private equity experience, comes to us from UPS and Goldman Sachs. And then Sean Braswell, who's been with us for 3 years, fully focused on private equity, but he has a background with Credit Suisse, B of A, and Loop Capital. Next page, Michael. So just wanted to review the role of the private equity portfolio in the plan. It's simply put to generate alpha over the public markets. You heard that earlier today. We're not investing in private equity for the purposes of diversification. Rather, we're being tasked with returns. We want to be more concentrated, larger commitments, larger check sizes, and we have a big emphasis on co-investments and direct investing right now. The current allocation is $8.1 billion as of May 15th. Kevin touched on, that we don't have a target allocation or a budget for how much we want to commit every year, but we're just over 5.5%, and that's at the lower end of the range being 3% up to 18. So we have a lot of canvas to work with right now. And as you can see from the chart, Matt touched on this a little bit earlier, private equity falls within corporate equity allocation alongside of public equity, and then that all rolls together into equity with real assets. Next page. So performance as of year end 2025 is shown. This is time-weighted figures. We outperformed the current benchmark over the 1, 7, 10, and 15-year horizons. The benchmark is a combination of MSCI private capital indices, 45% buyout, 25% VC, and the remainder being what we put in place as distressed. However, we're going to make the change that Matt discussed earlier. We're moving to MSCI all private equity. That's the second row of number, or third row of numbers, our forward benchmark. You can see that those numbers are higher, so our bar is increasing. Over the years, performance was impacted by a number of things. We had an over-reliance early on when this was being formed on fund of funds. We had a forced secondary that took place as a result of the GFC, and we had most recently inconsistent deployment that cost us. But not everything was negative. We had a lot of positives over the years. a product of the times of really not being able to invest in funds over 8 years, by and large. We focused our efforts on co-investments. And I think the program or the efforts that we put in place have really paved the way for where we are today. And we're just going to enhance those on a forward basis. We were able to do a lot of good things with growth in VC. And, if we look at what I would consider our core managers of yesteryear in that space, we had a pretty positive IRR. It rolls up to about 18% over those timeframes. Over those managers. And one of the things that's good, I guess, in a way, is because we were inactive over the course of 8 years, we have a lot of dry powder. And so we can do a lot of interesting things from this point forward. Managers know this already. That we are of scale, that we can respond quickly. We're being shown a lot of opportunities on the co-investment front. Biggest issue that we face is we're seeing so many opportunities. We need to be selective and right with what we do. We could be wrong on what we pass on, but we want to be right on what we do. Next page, Michael.
Hey, Craig, quick question, and I may be jumping ahead and asking this, so apologies. But and you probably know this, in the Bain annual report, they talked about for private equity, for every dollar you put in the fund, the average large fund is giving you 33 cents of co-investment dollars. But there's obviously a wide range. Is your goal and perspective that we can do much better than that or exceed that over time?
Brian's going to touch on this very shortly. But yes, the answer is yes. So on this page, top chart is again time-weighted performance, but now it's broken out into the subcomponents as well. The weakest piece of the portfolio was fund of funds. The good news is it's a small piece of the portfolio from this point forward at 460 million, so it'll be less impactful. And there was one bright spot. It wasn't all doom and gloom in fund of funds. We had some exposure to venture capital fund of funds, and they've actually done well, relatively well, considering 2 layers of fees. However, it still cost us because if you looked at our core venture capital funds and just ran their numbers, we outperformed versus the fund of funds, and you would expect that. So we would have been better off just taking that capital and doing it directly ourselves. The growth VC line doesn't resemble what I just commented on. Like from our core, it was 18%. We expect this to improve dramatically going forward. We're getting access to a lot of good names. We'll touch on this shortly. But I do think the performance in VC is going to vastly change for the positive. Special situations includes lower returning strategies, such as secondaries, which are low to mid-teens at best in general, if it's an LP stake. But most notably, we used to focus some of our time and attention on distressed for control strategies, and that really hasn't played out from a performance metric for our portfolio. Brought it up, I think, about a year ago when it was with different board members, but we basically had to comment, should we even be looking at distressed for control? And I think the outcome was, let's leave that in the non-investment grade fixed income portfolio. The bottom chart is for 2010 and forward vintage funds. Why we started thinking about the portfolio very differently. I want to have a reliance on fund of funds. We're doing things more directly. The IRRs are the first set of numbers, and see 5, 10, and in inception to date, 14% IRR, and that's with putting a lot of money to work. That we're going to be impacted by the J curve. It's nice to have a board that understands that because you have to explain it. The next set of numbers in the middle are the PMEs relative to the Russell 2000. Direct alpha annualized excess return was 4.18%. And the number on the right, there's an error. This is Kaplan and Shore K&S. There's a typo. It says 1.16%. It should have been 1.16x as in multiple. So, that's for every dollar that we would have put into the Russell 2000, we actually have 16 cents more over that time frame. I would say too that if we were to look at inception to date on the Direct Alpha, because of the fund of funds and secondary, those figures are actually negative. So we were hugely impacted from real inception. Next slide. Value creation strategy. We're focused on VC and growth, said a number of times, while we're being selective with buyout strategies. More of that will be discussed with Sean and myself. Brian's going to touch on the co-investment strategy. We want to reallocate our time and attention on things that are really going to drive performance, but we have this legacy portfolio that we need to contend with. Ben's going to discuss our initiative here on addressing the legacy portfolio. We want to cross-collaborate amongst the asset classes more than what we've been doing. We've actually looked at a number of co-investment opportunities across the groups. We spend time on the phone with managers discussing opportunities. We want to do more of this. Team additions. We'd like to add at least one, if not two individuals, one that can enhance our co-investment initiative. And we want our name to get out there more. I don't know how much more that can be. I think everyone already knows we're back in business, but maybe to just steer them in what we're really more attracted to right today as opposed to anything. And with that, I'll turn it over to Brian.
Thanks, Greg. Nice to meet everybody. Dan, to answer your question up front, if we're not getting one-to-one, then we're not doing our job and doing it appropriately. And part of the dynamics are we can use our scale, and then the way we approach engagement and execution can really make us a value-added partner to the GPs. So a lot of LPs want co-investment, but they really can't execute on it. And also they do it passively sometimes by outsourcing it. And in my opinion, that's not the right way. Not only do we want the returns, but we want the increased engagement with the general partner. And then we want all the qualitative benefits, the knowledge where we develop that institutionally, and then you can take that across multiple investments. So that's been part of the goal of this. And then on the slide, this gives some information about the co-investment program, and it's only partial information because it's evolved. The top part shows the mature tranches, which we started co-investing in 2018. And as Craig mentioned, that was out of necessity. It was the only way for us to get capital deployed. These are deals we sourced, we executed. We had an outside relationship with a manager where they warehoused and did the legal execution, and that was the key. Being able to operate and do our diligence and then have legal closing in commercial timelines. And so as we did it, GPs found out we could execute, and that allowed us to source and execute deals without the primary commitments. Fortunately, it led to some primary commitments, and we continued to build some momentum. So from the top on the mature tranche there, the first level, you can see we've had just about all of our money back. And overall, in the 26 investments, we have an 18.1% IRR net, accretive to all time periods for our portfolio. And this is as of September 2025. But from what I've seen, the performance will actually move up from there, given the underlying financial performance of the investments. So that's there. And then in addition to this, we have more capital we've deployed, which I'll get to. Any questions on that? The chart on your left shows vintage composition. So as I mentioned, we started in 2018. We built some momentum. COVID hit in 2020, and that put things on hold. Then we started re-accelerating. 2024 was a little bit slower because that was an election year and a transition. And then we really hit our stride in 2025. And this slide includes the co-investments up top, plus an additional $450 million that closed right around that September timeframe. And so the whole goal now is to continue that momentum. In 2026, we've had an additional $750 million across 3 investments that closed in May. And one of those was cross collaboration. We work closely with Ty and Multistrat, Greg and Public Equity, and we were able to pull from a lot of different resources and really do some good diligence and access some scale, not only in our program, but also in the public equity program. And then it's mainly North American driven. We have some European exposure, and there really isn't any industry over concentration. Pretty much financial services, IT, and healthcare are right about 25%. And there really isn't any overexposure to a general partner. There is one where we have a really good return. And so that one is at 23%. Two others are right around 15%. And then the others all single digits. So we felt like we did a really good job on portfolio diversification. Having said that, the new investments where we can get really high conviction, some incremental insights, we're scaling in. There is more diversity initially because as we were building the portfolio, we didn't want to have one large investment blow up. And it was also the methodology we had to use to get approval. There was concern about optics, about too big investments. So we have a lot of momentum going in the co-investment program, and I'll touch on some items that we're going to focus on going forward.
Just a point of clarity, when you said 23% or a lot in the high single digits, that was all allocation, not performance. Single digits.
No, that's where the NAV is right now.
Yeah, okay.
Getting to pacing for a second, you see on this graph, 36% of co-invests in 2025. That is $400 million though, right? In terms of multiplying through relative to the plan size.
That's $450 million plus three other direct co-investments that are part of above.
My point is acceleration doesn't mean too much.
Yeah.
We still have a long way to go in terms of getting capital at the scale we want, given the denominator. The team's done a great job accelerating, but don't extrapolate this as overdoing 2025. That's underdoing the program.
Correct. Yeah, and this is as a percentage of deployed.
Right.
Right, quick question as you go to this next page. What is I mean, we're philosophical and some of it's on here. What is an NCIA co-investment? Like I did a lot of this in my career. I always found like it's good to define what is it so you're getting the deals. It helps in sorting through stuff.
I agree, and there's a couple different dimensions you could put on that. When we were starting out, we focused on some real key areas, mission critical businesses where you had recurring revenue, preferably contractual if you could, low entry valuations, strong EBITDA margins and growth, and then also strong free cash flow conversion. We're trying to avoid consumer cyclicality. We said if we're doing financial services, we don't want balance sheet risk, underwriting risk, reimbursement risk in healthcare. So we identified things we didn't want to see and also prioritized certain deal specific characteristics. And since we were sourcing and not relying on GP relationships, we de-emphasized that GP and how good they are. But one other component we add in is this a high conviction general partner? That goes into our primary commitments. And then with that high conviction general partner, is this down the fairway for what they're doing? Do they have experience here? Have they shown proven results? We've done two large co-investments with a GP where we don't have a primary relationship, but they have massive experience in the healthcare area in CROs, CDMOs. CROs, this used to be the epicenter, maybe still is for CROs. So we were looking at what they did and we said, okay, we can trust that this GP is going to be able to execute on these co-investments here. As we move forward, we've been taking a little bit more thematic type of approach. As Kevin mentioned, we're saying we think now is a real interesting time to be scaling into venture, into new disruptive technologies, AI, computational power, all those type of dynamics. So now we're looking at how can we access the co-investments there. And then what we're also trying to do is one of the bullet points here philosophically is we want to be flexible. So we don't want to miss the smaller deals that potentially could be very high returning, but takes as much time as a large scale deal. But if we set up the structures where we have a primary commitment in SMA, where we have the opt-out optionality, and we have the flexibility to scale it on larger co-investments, then that gives us the ability to say we're going to align with this general partner where it's high conviction, and that'll help us achieve hopefully more than one-to-one co-investment. Does that answer your question?
No, that's good, very thoughtful.
Sure.
So moment in time too, distributions were drying up for a lot of LPs and GPs who would normally just go to their LP base to see if there's co-investment interest and probably have it all taken. That wasn't taking place. So they had to go out to others. And word was out there that we were interested in co-investments. So we had a lot of opportunities that came our direction that probably wouldn't have otherwise done so had not been the markets the way they were.
And there's always some hesitancy if a GP hears, oh, you're doing it. But what we proved was they wanted to deal with us because of our execution. So you want to be a good partner to the general partner. They want to deal with somebody who isn't going to impede their process. And if you can come in and do that, act very quickly, be thoughtful, then they look at you more as a partner and they say, we want your primary commitment. So my goal is to be the first call by a general partner and have them say, and we actually had that from one experience. They came back, we did a pre-syndication co-investment. So that goes into the flexibility also. Can you look at it at different stages in the development of that co-investment?
And we've said a lot of no's, right? I mean, that's just as important as getting to the finish line with a yes. So GP appreciated it's a quick no. And we've had actually a lot of recommendations that went through our process and we weren't able to complete everything.
But to your point, Dan, being able to give a quick no, having us in our framework, it's easy. It's not easy, but it makes it more efficient for us to say this isn't fitting in this wheelhouse. And then the partners appreciate that. Part of it right now is we're seeing so much deal flow, and the last bullet point is more resources. If you execute, that winds up driving more deal flow, and we want to make sure that we can address everything on a timely basis.
I mentioned adding to the team. We're in discussions with somebody. It's 2 people right now.
So do you view this, as you sit back and kind of look at it, do you view this as a portfolio on its own, where you're going to judge it as a portfolio on its own, or do you just view this as additive to the overall PE allocation?
Personally, I take pride in the performance of the co-investment, so I look at it on an absolute basis. I want over 20% net IRRs, but I think we have to view this in totality with the private equity program. And even we can do that in combination with public equity for accessing opportunities where we can put money to work that avoids the traditional fee structures and economics, allows us to scale in where we have really high conviction, and then get that outperformance that benefits the overall program.
I guess the slight nuance in the question is, when you look at concentration levels or you look at portfolio construction, I can see in a co-investment portfolio where I might limit myself construction-wise because of certain concentration limits. But if I'm looking at it across the whole private equity portfolio, I might let some of those concentration limits kind of be impacted by what I have in other spots. Trying to weigh that.
Can I weigh in on that?
Yeah.
So one thing we're trying to drive though, and again, it is a source of tension, is we want to optimize the total plan.
Right.
Not even at the private equity level.
Yeah.
Right. So within private equity, if the goal is to complement the total portfolio, then we should be willing to take much more concentration risk and not kind of optimize in the local, smaller asset class. So again, we need to be convinced that we're getting quality co-investments and that we can concentrate and take that exposure. But that's a direction of travel. Not think about it as do co-investments complement private equity platform, but what do they do for the total plan?
I appreciate your pride and authorship.
Oh, without a doubt. And the scale, as you mentioned, we get input from Brad and Kevin all the time. And so 2 recent deals, one that Ben worked on, 300 million, one I worked on, 400 million. And if you can do scale, it actually has a lot of benefits. That 400 million combined with another manager allowed them to lead that CV. So we're able to negotiate more favorable governance terms. We're able to push a little bit on the valuation. So we're trying to lever in where we can and use our scale in any way we can.
Do you think as we evaluate this as a way to kind of a different mode of doing private equity, will we be fair in kind of our evaluation? Because you could have extra concentration because you're benefiting the portfolio as a whole.
No doubt about it, but I think the tension is always going to be later.
Yeah.
The reality is if we get capacity of 300 or 400 individual deal, that's fantastic.
Yeah.
Trying to get beyond that is really hard. And trying to manage 147 is the bigger challenge.
Well, and that's another issue, the number count piece.
Yeah.
And
I wasn't sure of your point, Brad. Did you say getting more than 400 is tougher or?
Hard, right, to get in great deals because you have a lot of people who still have active programs and we're not the only ones trying to do this.
Right. One area where you can leverage in now is in the continuation vehicle market.
Sure.
That's evolved from the lower quality multi-asset CVs to now the higher quality single asset. And what you see is in these deals, there's on the lower end, 7 new investors up to 15. And the average size is $1 billion. You have the GP crystallize and carry, and 50% of the deals have cross-fund investments. But the last one we saw and worked on was $2 billion of equity. And so what we've seen on the CV side, because of where they are, that you have a little bit more flexibility there.
a bit out of my league on the pension side of the world, but what are you doing on the monitoring or board or, board observation or anything on that side?
The monitoring of the portfolio. Right now, we have an outside relationship that gives us all our reporting, handles all the calls and distributions. Craig's going to talk about the next evolution of this. And so really, we get information from the general partners. We're in discussions routinely, but that's one of the bottom parts where, hey, for resources, getting some more infrastructure around it.
So where we are an existing LP of a fund manager, we're in the fund likely with that co-investment. So we're getting updates. And where we're not, a lot of these co-investments they'll have for all investors, just an update call on a quarterly basis. So we're able to participate in those.
We're not taking board seats. These are through fund structures at this point in time. At some juncture, we may consider a direct corporate level investment being on the cap table. We're not there at this point.
Okay.
Why don't you jump forward in the interest of time to touch on the platform and then let Ben talk about the.
So this is an effort across the alternative asset classes is to put in place a platform for co-investing, direct investing. So we're in the midst of conducting a search for one or more external partners that can help with our objectives. And just to repeat what's on this page, a group that can enhance our deal flow, expand our resources, monitor, and hopefully results in better performance overall. Hope to have this in place by the end of June. It's going to take a little bit longer though, especially if we're going to hire an additional individual who might want to weigh in on what this could look like as well. That's my take. But there was a lot of groups that are interested in doing this with us. So I think it'll be a positive outcome at the end of the day and make us that much more liquid.
How do you think, Craig, about internal versus external, maybe long over a 5-year period? Say, like having more resources to do instead of hiring an external firm to help. Maybe could that be a transition and we do more internal or
So something. Well, this is a discussion that we can have, but can I just maybe something as simple as legal resources. Can we just rely on somebody that's going to close a deal externally at a manager to take care of all that stuff that, that might be an area that I would want to keep external rather than bringing someone on board. I don't know. I mean, this is just me speaking.
Yeah, so we have an existing relationship where we're able to take the co-investments and we're controlling the discretion around whether we do the co-investment or not. And then from that point forward, that firm and asset manager is handling kind of final legal diligence closings, and they handle some of the monitoring as well, although we stay on top of it. The thinking is that's essentially not been set up as a fee for service. It's just part of a broader relationship. We prefer to have something that's fee for service. I do think Bill has done a great job building out our external bench of legal resources. But having this ability to move in real time with a third party to handle a lot of the closings, that is definitely value add. So it allows us to engage with the market more directly.
And, you know, just to be clear, we're not outsourcing the decision-making. We have discretion. These are deals that we're finding, or they may find with us, but the decision-making is going to be a combined effort. Rely on us, really, at the end of the day.
One thought I'll share, just an observation about internal team resources. This is something that I think you've seen in a couple of other shops as well, but we have a dedicated sourcing team so that you don't have to tools down when you're, you know, underwriting and then actually handing it over for close. And we've seen it's really driven a lot of really robust deal flow for us. It's been differentiating on the independent sponsor side of the equation. I mean, we've got 3 people and that's breakfast, lunch, and dinner. That's all they do.
It's a different skill set. I agree with you.
Yeah. But it might be something, if you guys are really trying to move quickly, differentiate your capital and so forth, might be something to consider.
I'm sorry. The one bullet point we didn't touch on is we've actually expanded to interacting with intermediaries. Sean's talking to them, we're sourcing. So, you know, we're trying to do as much as we can on that, but you're right. When you get involved in a deal, you know, you're focused on that and it's time constrained.
Yeah, we're using this loosely terminology in the strategic plan around go-to-market. That's the idea that we need to interface with the market more directly and intentionally around sourcing. And it can be targeting specific GPs that we want to work with over time, but it's also maybe we talk more with investment bankers and these other kind of, you know, resources. So that is something that, yeah, you need to figure it out, but that's the intent.
Sean, maybe if you just want a couple comments on.
You had another comment.
Just one more thing to share, which is AI related. It's probably something my team would want me to share, but we've built some agentic capability to identify people that are spinning out of large firms prior to when that occurs. And we're really canvassing the marketplace in a much more efficient manner to identify those folks so that we can have that conversation even earlier. Something else to just pass along.
Yeah, when it comes to the intermediaries, the deal flow is out there. You just have to be present and take the conversation. And the more deal flow they show you and the more conversations you have, usually leads to, yeah, exactly a recurring type of conversation.
And you have what, a couple of groups that you just have outstanding calls with, like just
like
calls.
So like 5 groups who have monthly calls with me.
Ben, you want to talk about the legacy project?
Yes, the legacy project. So in addition to the normal day job, we get to help with this effort, which isn't private equity only specific. It touches all of the private markets portfolios here. It's actually been really interesting to work on and be a part of. And what we're aiming to do here is find an offload type solution. Offload can mean many different things. To alleviate everybody's bandwidth and time constraints so that we can focus on those highest priority items. You can see the purpose, kind of some bullets there on the left. You can see the numbers for each private markets portfolio on the right in that table that each of the teams sitting behind me have helped identify and put together. So as an aggregate, we've gone to a whole bunch of different groups and asked for solutions, everything that's as simple as monitoring to something more complex like a hybrid solution or a CFO or a straight up secondary sale, and weighing all those alternatives in order to find out what's the right solution for us. I guess I should back up and say, what is the legacy portfolio? The legacy portfolio is a select list. The number of line items are there. The general character of these line items is they're very dated. In the private equity portfolio specifically, I think we have a weighted average vintage year weighted by NAV of about 2013. So the items in this list are very old, way past the 10-year limit, and in general are not the most attractive things to bring to the secondary market. Now, that doesn't mean there's not buying opportunities there where that presents an option for us. But in the grand scheme of things, they're not going to generate the most interest. So we have to weigh that too when we think about that option. But that just gives you an overview of what we're trying to do there and kind of the main point of it. The overall size of what we were looking at was, you know, that list comes to between $1 and $2 billion, broad strokes. Overall, that's a relatively small portion of the entire plan, but it has been a good project. It's in process. We've actually, just in the past week, asked for some updated pricing on the secondary market of each of these portfolios just to get another look into what that looks like at the moment and options for us, and hope to come to a decision in the coming months on where we go with this. And the idea behind it is we would have a permanent in-place solution. So while we might seek liquidation on certain line items or on even a large part of it, this would be in place with an outsourced group to handle all the monitoring and reporting back to us as needed. And then we could put things into it in the future as certain assets become dated, don't need our time and attention, are no longer a core relationship of these different teams. So hopefully it's a resource that benefits kind of the broader plan. That's the main point. There is a second slide on it, which I can hop to as well if you'd like. It's just a little more PE specific.
Then is the cost of that more like an administrative fee? Should I think about it, or is it more of an active management fee? I'm just curious.
So it's mostly administrative. If you're on the monitoring end, if we said, hey, we just want this to sit somewhere, don't do anything with it, how cheap can you do this for? It's like a fee on NAV. So there's a component that's like that. And if you want to undertake other things, like I want you to sell this, generate some kind of product, you get pricing related to those activities that you'd be familiar with.
Thank you.
Yeah, sure. This just gives you a little bit of a view into just the private equity look. So why did we choose these line items? Like I said, they're all just very dated, mostly legacy, and some additional color at the bottom, but I'll stop there in the interest of time. And
We're not to the point where we're decisioning. We haven't even brought final analysis recommendations to our investment committee, but what we're struggling with is you look at the historic performance of a lot of these, it's actually quite disappointing. And so then if we look at the forward curve of performance and project it based on what they produced historically, it's very underwhelming. And I think there's a very strong chance that what we're carrying them at currently is far above intrinsic value. So when we look at the secondary market, because they're old, they're scratched and dinged, there's a huge haircut. But we shouldn't be comparing that to the carrying value. We should be carrying it to our view of intrinsic value. And that's what we're trying to figure out a solution towards, is that net, we park it with an administrative agent, gets it off the screen, and we have more focus on other higher returning type activities by the team. Do we just sell it into the secondary market and take a haircut? Or do we have a structured solution, which there's lots of those these days with the secondary managers. But that's the crux of what we're grappling with. And my own kind of perspective is we should have more liquidity in the private market investments, and we shouldn't be on autopilot. I'm not saying the team is, but we shouldn't be on autopilot to say it'll run off eventually. That we should look at this as active management, just like any other aspect of our portfolio. On the public market side, if something underperforms over periods of time and we don't have the conviction, we just exit. It can be expensive to exit in the corporate bond market. It's not cheap, right? So we should be bringing the similar philosophy. That's the idea. That's what we're trying to solve for. Again, we don't have a solution yet, but Ben's done a great job working across the asset classes and interacting with the market to try to figure this out.
Our data team has also been really helpful. Matt Grimm, Josh Haskell, done a lot of modeling work on the secondary impacts, go forward return expectation impacts, how it touches our overall performance, not just at the asset class, but at the plan, and trying to think about that in a way that solves our issues the best way we can.
I'll just make a comment. Kudos to you. It sounds like you're being very thoughtful about how you approach this. Oftentimes you see leadership changes and people just blow out the portfolio, and those friction costs are very painful over time. And it sounds like you're being as thoughtful as possible. It's true. I mean, I know the buyers on the other side that, there's a reason that they price this stuff cheap, but the best you can do is what you're doing. It's and thinking through it as thoughtful as possible.
Thank you.
And managing your return on time. Right? It sounds like you're doing something really well. Right?
Thanks.
So areas of interest. VC growth equity. Growth equity is synonymous with late stage venture today. So this chart, kind of a lot of information on it, but it shows you on the far left what was going on by vintage years. The green is what performed better between venture capital, early and late, versus buyout by vintage year. This is basically just an IR from MSCI. And then, so that's the first sets of green numbers, VC early and late versus buyout. The second is VC early stage versus VC late stage. But long story short, we have been attracted to venture capital for quite some time here in the recent past, and we've been deploying money. We have an opportunity set that we never thought would materialize. Treasurer was kind enough to give us kudos about getting into some of these managers, but it's a team effort, and he was part of that as well, opening doors to managers that just want to give us the time of day before. And we are trying to develop those relationships, and there's going to be more to come. We think we're at an interesting point in time in the market with a lot of these groups. Longer, private for longer, that's going to come to an end at some point in time. We could have a big IPO next month, and that may pave the way for a lot of realizations, and we hope to be able to capitalize on that. Recent activity, Andreessen Horowitz, Maverick Silicon, Bailey Gifford, and Coatue, which we worked closely with our public equity peers. And most recently, just within the last couple of weeks, Y Combinator. And if you notice, well, it's not on this page, it's the next page, actually. A lot of these late stage names are going to be accompanied with co-investment opportunities. We've done a few, and we know that's going to grow pretty meaningfully. I don't think you'll see us co-investing in early. I mean, that's, it would be more of just the late stage things that we can underwrite. That's pretty much what I wanted to cover on this page. But
we should give us a sense of total scale that's represented across what we've done and are in the process of closing, and how you all think about what is too much scale in those portfolios for VC environment.
Sure. I'm happy to jump to the very end and then back one page and go in here. Keep going. It's in the appendix. Sorry. This is, oh, I'm back. There you go. So this is what we've done over the last year and a half almost. And if we start at the bottom, you had Y Combinator for $370 million. Keep moving up. You had Andreessen Horowitz, $4 billion. Maverick Silicon, 300. And then a side, well, that was a side vehicle. And then 100 million into their main vehicle. So those are pretty sizable numbers from what we've done so far. And the pipeline of future things is fairly large. It's just a pipeline. It doesn't necessarily mean we're going to do all of them, but I could see this easily being another 2 to 3 billion over the course of the next few years. In the scheme of things, relative to $150 billion pension plan, it's not super large. So, and again, this will be accompanied with co-investments as well, a lot of them. So it's meaningful.
Not to put a number in your mouth, but $1.5 billion-ish per vintage year.
Yeah, that's fair.
What I see when I look at this pipeline, is that a fair number?
That's fair. Definitely fair.
To the knowledge.
The wild card is co-investments.
Totally. But I think we feel like that's at a sustainable pace, to say the least.
Yeah, again, a risk factor that's been highlighted before, Chair, is this duration of capital, right? So if we get really strong returns in the early stage venture, that could be 15 years and longer, that the money stays invested and it's not coming back to us. So we do need to manage that. And again, we're trying to find areas where there's optionality And that's where co-investments come in, whether it's within an SMA, where we have the opt-out right, or it's these one-offs that we're doing as well.
Can you flip back up? Sorry. Keep going. I'll tell you when to stop. There's that. Wait, come down. And one more. So one area that a lot of these groups have in common is the topic of the day, AI. And Sean's going to say some comments on this.
So when it comes to AI, we've been very thoughtful and positively aggressive on where we want to spend our time. So we bucket that into 3 layers. So the first layer that we look at is the infrastructure layer. And when I say infrastructure, I don't mean any data centers. That's for our real asset colleagues behind us. So for infrastructure, I think compute power, so chips, semis, AI, cloud, and all of that. So we were able to source one early stage manager, high caliber, which also led to an introduction to another high caliber early stage manager that is currently in diligence phase right now. And then that next layer is the foundation layer, foundational models, LLMs, which allowed us to have cross-platform collaboration with our public equity peers on where we think is truly going to be the winner in this inflection point of AI. And then the high expected return area, which is still in the early phases, is the AI application. Through various managers from A16, where we have that 1 billion was allocated across 7 funds, and about 65% of those funds are early stage and specifically are tailored to the application model. So we've been very thoughtful, and all of this comes with having high quality, top quartile managers, like the treasurer mentioned. We are in diligence stages with some groups, which are really exciting. Y Combinator gives us that super early pre-seed and seed stage exposure on the application across the 4 batches, which is going to be 96% tailored to AI. So we've been very thoughtful about where we spend our time, and this is sort of our thesis and where we think the opportunity lies. And go to the next slide, Mike. And this thesis is also revolved around our exposure into buyout software, which we're using these top quartile managers to hedge our buyout exposure with the risk of AI disruption. But keep in mind, out of that $2 billion valuation for Q4 2025, that is about 10 companies. One company is a unicorn, which is sort of the connects the tissue for data integration with AI. 4 of those companies Brian touched on, which are co-invest from the past 3 years ago, which have their own proprietary data, so not much disruption from then. And then the other are exposures from various vintage fund commitments.
So our software approach right now is just one of caution. We're focused more on what we think. And quite frankly, there's mixed views around the table. But, if we need to be right with what we do, we can be wrong on what we pass on. So taking that cautionary approach, and it'll probably take years to play out on what really truly happens to software. I think we're playing in the right area.
Just maybe a comment, and this is weaved throughout the material and you talked about it. I think important is some of these relationships, very smart to be building these, make sure we're cross-pollinating amongst the team, right? Like, I'm not going to comment on software because we could go down a rabbit hole, but there's obviously a massive public opportunity there. Lots of publicly traded companies, I should say. But there's a lot of the AI first stuff is private, right? And we want to make sure there's sharing of information that will help make better decisions at the end of the day, which I know you all are doing, but I continue to encourage that amongst the team.
And then just wanted to wrap up with areas of interest, and I'll be brief. So the industrial area, reshoring efforts, AI-driven automation, and a lot of governmental policy support. Healthcare and life sciences, that's been an area that has been beat down and looks a little bit more attractive today. Just need to avoid reimbursement risk and regulatory risks. And then another area, more geographic, Japan looks very interesting today. It's rebounding is a nice way to put it. At least it's remaining flat. Actually, had a few conversations on this. It's just an area to explore. The issue would be that deal sizes are fairly small, like an entire deal could be 70% of deals that were done within the last year or two have been below 500 million. So if we're going to do co-investments as well, I mean, just make pretend 500 million, call it 50-50 debt equity, 250 equity. A fund might do what 150, there's really maybe not an opportunity for co-investment. So something we need to think about. And that wraps up the presentation. Any questions?
All right, thank you. We are running long.
Sorry.
No. Kevin asked for interaction. Didn't know what he was asking. So as not to torture people, let's take a 10-minute break and then we can come back to the strategic plan. We'll reconvene at 11:25.
There's your motion.
Great now.
You should have done better.
Well, we're green now. All right. Call back to order the NCIA board meeting. We will turn it over to Rhonda and her team to update on public equities.
All right, thank you. Good morning. We are the less sexy asset class, boring. Everybody's probably heard most of what we want to talk about, but we do want to dive in. We have about 30 minutes to just kind of get into how we think about the portfolio. This asset class is a bit of a unicorn in that we cover the public equity assets. We have access to hedge fund assets that are primarily equity in nature. We have a large internal management book, and we also have access to flexible deal flow through private to public co-invest opportunities. So these guys wear a lot of hats, and I want the opportunity for them to kind of talk about what their day-to-day looks like. I'm Rhonda Smith. I've been with the plan for 23 years. All in the public equity space, and this is my team. I'll have them introduce themselves, and then we'll just kind of talk about what that team looks like going forward.
Hi, Greg Taylor. I've been with the plan just over 10 years.
I'm Hunter Brackett, been with the plan just over a year. I've got over 20 years of experience doing manager research as well as fundamental research, both sell side and buy side.
Kyle Blue, been with the plan for just over 3 or 4 months or so. I came from a cap trust and previously was on the private wealth RIA space. I was in the private wealth RIA space.
At this team, we by design selected backgrounds that are very complementary to one another, building on the strengths of each other and being intentional about how we want to build the team going forward. Kevin has been very supportive, and as we are focused on expanding our internal capabilities, which Greg will talk about momentarily, that's going to need more headcount on our team. Our focus on that headcount is going to be looking at people with depth in fundamental research, people with experience in internal trade management and support, things that will kind of undergird the opportunity set that we have in internal where, Greg started this thing, we're at the floor and we have the ceiling that we can reach towards, and there's a lot of opportunity there. We just need the resources to be able to support that. Next page. All right. Portfolio objectives. I'd like to kind of set the stage for the purpose of the public equity portfolio and then hand it off to the team to just talk about what keeps us busy. Attractive absolute returns. Long-term portfolio, you've heard from Craig, their focus under the corporate equity umbrella is return seeking. Ours is too, but primary purpose for us is the diversification component. opposite private equity, this is our focus. We want to exploit market dislocations through the utilization of our internal capabilities, through hedge funds that are primarily equity in nature, and then looking at thematic special situations and sector industry opportunities that we could potentially do low cost in-house, but those that we find that there's less of a cost benefit for us, looking externally and seeing where we can add to our opportunity set at the margin with external managers. Now, we want to be careful about how many external managers we're building out. We're focused on strategic partnerships, relationships with managers that we feel like there is some give and take there. We can get some of the things that we want accomplished on our own, and then we can look at them to see how they can assist us in kind of moving the portfolio forward and getting return objectives at the margin. So this is a little bit different for us. We're a little bit competitive. We want the returns and we will continue to seek the returns, but we do want to also make sure that we're providing overall diversification for the plan. Next page. All right, how do we go about achieving this? Greg will talk about the internal management a little bit more, but the inception of this portfolio was 2017, and we eliminated a lot of external passive management on the domestic side and took advantage of doing that in a low-cost way internally. So that was all full replication. And then Greg came through and built a internal factor portfolio where it kind of offsets some of the exposures we've had to MAG and some of the sensitivities that we've had in more of the large cap space. And he can talk a little bit more about that as well. But also the internal provides us flexibility at the plan level to rebalance and provide cash needs for other parts of the plan. And we can be nimble in doing that and ready to be able to implement at a moment's notice. So that has been a game changer for us. And that was something that Treasurer Brenner was very supportive of. January, second week in office here, where we were able to actually rebalance the portfolio for the first time in about 9 years. So that has been helpful. We've been diligent about rebalancing that and staying within targets, and now with new strategic targets, working our way down to kind of lowering that equity exposure over time as well. Customization, as I mentioned before, we want to kind of continue to build out the internal and seek opportunities with these thematic and special situation portfolios, and you'll hear a little bit more about that as we talk about areas that are of interest to us. Strategic partnerships. We've been working closely with our private equity group, utilizing our existing long-term relationships with a couple of the managers where we have had positive success with co-invest opportunities, where these managers have been able to get in very early in some investment opportunities that they anticipate will IPO over the short term, but they're going to hold them a little bit longer in their long-term portfolios. Given that we're a long-term investor, that's appealing to us. So we have the size, we have the scale, which is another area that can be a benefit and a curse to us. We can put a lot of dollars to work, but we have to find the right areas to do that. And it has been challenging in some spaces like small cap or areas where, you know, to move the needle in our portfolio, we need about 250 million or more to put to work. And that can be a challenge at times. So looking for those right partnerships, looking for the ability to kind of, if we can't get in at the 250, how do we scale in over time? But just getting those in line is something that we continue to work on as well. And then risk mitigation. The internal capabilities, we can manage our total portfolio concentration risk and other risk as we continue to grow this out. And then looking at our structural analysis of our portfolio, where are our misweights? Where are we underweight? Where are we overweight? Is it intentional or not? And how do we go about correcting that? So those are areas that help us to achieve the outperformance that we're seeking. I'll now hand it over to Greg, and he can talk a little bit more about the co-invest opportunities that he's seen and what we've done in that space.
Yeah. So over the last couple of years, we've seen some opportunities from more traditional public market investors who have kind of started looking at opportunities more in the late stage private markets. So those have been some good opportunities we've been focusing on. And prior to that, we've done a few select co-invests in public markets. These were more focused on either individual names or buckets of names where there was a dislocation and they seem, especially undervalued. So we were able to put more capital to work in some of those. So yeah, as private equity mentioned, this has kind of been cross-team collaboration, and we've worked closely with them on the private deals, the due diligence, and definitely noticed that we benefit from kind of being able to access the high conviction ideas through multiple sources to get scale where we want it. Yeah, I think kind of see this as a pure source of excess return versus the diversified market base we get from the bulk of the portfolio. So next slide just kind of goes over some of the recent history and what we've done. So as I mentioned, there's public equity co-invests in 2019 and 2022. It's taking advantage of some broad market sell-offs where some companies that looked attractive got caught up in that. So we looked to take advantage of those. And then more recently, some of those late stage co-invest deals that we've come across. So kind of being very selective in just focusing on the highest conviction ideas. Made the first one in 24, several more last year, and a couple more not shown here year to date. So yeah, I think going forward is an area we'll kind of keep top of mind and continue to work with private equity on.
What's the total dollars for 2026 for those handful of deals?
Through us, it's 244.
Next page. Kyle will get into talking about our portfolio exposures as it stands overall, total equity.
Perfect. So brief overview of the portfolio. So as of today, it's just under 59 billion, about 58.6 billion. It's actually tripled in value with significant outflows during that time since 2017. Moving over to the top right, you can see the current active exposure of the plan. So the international portfolio is more active than the U.S. So as of March 31st, 23% of the U.S. is active exposure, 60% of the international is active exposure, and 38% of the total portfolio is active. And you can see how that trend has changed throughout time as well. So on the bottom of this page, just to clarify what we're looking at here, this is rolling realized tracking error. So this is calculated on a 3-year rolling basis using monthly returns. You can see that it peaked in March of 2022, and that was largely due to our tactical overweight to international stocks at the time. And as that is winded down, you can see where it is today. The rolling tracking error is 85 basis points, much lower than what it was before. So want to go to the next slide. I think Greg's got some comments.
Yeah, so just kind of showing here portfolio structure through a risk model lens, comparing where we are now versus last year. Kind of high level, there's been a marginal decrease in total active risk. And that's kind of been a fallout through some of the rebalancing that we've done. So kind of moving assets away from low conviction active managers within the US, focusing more on the small cap and our internal core factor portfolio. And then within non-US, we have taken out broadly our China beta exposure, still allowing some kind of active exposure where managers see opportunities, but that's been another driver of kind of that increase in specific risk.
And just to specify on this page, this is predicted tracking error as well. So the last was on a looking backwards ex post basis. This page is predicted tracking error going forward. So looking at the active factor exposure, so just want to highlight, factor exposures currently only account for 31 basis points of active risk. This portfolio is not taking a lot of factor active risk, and much of the active weights you see on here on the bottom side of the page, it's it's not intentional. It's as a result of our active manager allocations. So you can see where we are overweight small caps, and as Greg was saying, we're underweight China as well. Those are some of the main highlights. Go to the next slide. So we're going to briefly look at performance. So on this slide, really the two timeframes I think to really want to highlight. So the 1 year, it's been a challenging year for our active managers, specifically in the specifically our international growth managers, due to a few reasons, including security selection within tech, and then also stylistic headwinds. I do want to highlight that the 10-year, you can see the public equity portfolio is still positive against the benchmark. So over the long term, the portfolio has outperformed. The last year has weighed on that, but again, the long-term returns have held up. So if you want to go on to the next page. So a brief comment on this slide. The original slide that were sent over had the preliminary performance. And so these numbers are the finalized numbers. It changed it a little bit, but it's a lot of the same story. Essentially, our international managers had the challenges that I was just referencing, and they detracted from performance over the last year. Our internal portfolios did add to performance that Greg was referencing earlier and is going to talk a little bit more about as well, but outweighed by the performance of the international active managers and to a lesser degree, the U.S. active managers. And then from the allocation effect, so this is, how this is the effect, the impact, the return impact of where the different benchmarks that we allocated to versus the U.S. manager excess return, international manager excess return. That's going to be the impact of individual managers against their specific benchmarks.
Any questions? Okay, we will hop over to peer comparisons. We don't want to be in front of you talking about underperformance. No one does. The headwinds have been brutal, but please know we are striving to kind of adjust that, correct that. We are extremely competitive, and we're kicking ourselves and trying to figure out, okay, where do we turn this around? The market's giving it to us, and we're trying to figure out how to fix it. Andre?
Yeah, if we go to slide 15. So we'll start with the good news. So looking at the domestic equity portfolio, and this is versus our public pension peers. So you can see we rank pretty well across almost all time periods, so top half of the peer group, in some cases top quartile. So having that large allocation to passive exposure has been beneficial to us during this time. Just given the headwinds that we've seen from U.S. active managers. We've also terminated several U.S. active managers over the last year. We talked about Brown on the small cap growth side. We also had an all cap growth manager that was terminated in the last year. So just in light of that challenging environment. So that's also been used as a source of funds to reduce our public equity exposure kind of in light of the strategic plan. If we go to slide 16, so this same comparison, just looking at it versus the Davenant Foundation peers, very similar conclusion here. Again, kind of that high passive exposure has been beneficial to us. So feel good about where we are relative to peers on the domestic side. If we go to slide 17, so the more challenging area, as Kyle talked about, has been within our international portfolio, particularly over the last 5 years. So the exposure that we have to growth managers, the challenges that they have faced has more than offset the strong performance that we've seen from our more value or core managers. So a couple of things to highlight. We do have a higher allocation to active managers within the international portfolio, as was mentioned earlier. That's been a headwind recently. Our growth managers have faced some stylistic headwinds due to the outperformance of value versus growth in international markets. That's really been the opposite dynamic of what we've seen here in the US. But even if you look at our growth managers versus the growth benchmark, they've lagged that benchmark as well, in addition to the core benchmark. So there's been some stock selection issues there. So this year, a lack of energy exposure has hurt them. They've benefited from significant exposure to semiconductors, but that's been offset by software exposure that has gotten hit within the tech space. So there's been some challenges, and Rhonda will talk about some of the how we've responded to that and kind of how we're positioned going forward. But that's really been the big headwind over the last 5 years.
Quick question, when you guys are showing the attribution allocation effect, are you just running that US versus international, or are you accounting for the allocation in growth versus value, let's say, in international?
So that's including US versus international, but then also within US and within international. For example, and I have the breakdown if you want to, if we need to talk about that, but there's within the US portfolio, let's say if we over allocated to small caps did well, then that would be within US allocation effect. And then US versus international, how much US did you hold, how much international? And then the same thing with international. If we had, say, if we have a dedicated EM strategy, so if we had more EM and EM outperformed, which it did over the past year, and that was something that helped. And that was a large part of that allocation effect.
Is the value versus growth getting picked up in the manager excess return though, or is that getting picked up in allocation too?
That's the manager. So on the international side, they're all benchmarked to a core benchmark. So
Yeah, so it's not true. The only reason I raise this, and we've talked about this before, and you guys have the data in here too. I mean, the performance is insane in the last 5 years in international markets. So it's like, I only raise it to encourage you, like, to don't get discouraged by it, right? Because it is insane. It's not truly manager underperformance and skills. I view that more as allocation, but trying to make sure I understand those nuances.
So we appreciate that because, I mean, as we're looking at our managers, it's not our intent that when a manager underperforms, we're firing them. That is not the case. We hire these managers and we put a lot of diligence in it on the front end to look at, where are they adding value by way of skill and their ability to identify, really good opportunities, and how does that complement our portfolio? We look at it over longer periods of time. So we know when they're going to have a tendency to outperform and when they're going to have a tendency to underperform. And during those times when they should be outperforming and they're not, which has been the case with some of these headwinds, we do dig a little bit deeper to try to figure out what's driving it and whether those decisions by the portfolio teams were valid or whether they were just mishaps. And if they were mishaps, what happened? So we have dug into all of these and, I can jump into that slide shortly, but there is a manager that we still have conviction in. We believe the story. We understand why some of the decisions were made, and we understand why they're sticking to their discipline and not investing in certain sectors. So we want to see, does this still fit our portfolio construct over the longer period of time, and give them a little bit more latitude there before making any final decisions. So it's been tough. Taking a haircut, looking at opportunities to reduce fees during those times. Those are areas that we try to take advantage of when we still have conviction in the manager and we believe it's going to turn around in a period of time. I'm sorry, Hunter.
We can skip to slide 19 just briefly. So this just provides a little context of the environment that our international managers have been operating in. So the slide on the left, you can see the significant underperformance of growth versus value within the equity ex-US indices. And growth has really given back all of its outperformance from the pre-COVID period. You look at our international growth managers, the valuations of their portfolios are now trading at historically low levels despite solid earnings outlooks. And so that's another reason why we're trying to be patient despite some underperformance. And then the chart on the right is just a couple of trends that we saw, particularly last year, that were headwinds. Big rally in European aerospace and defense and banks, two areas that some of our managers have had very little exposure to. Those trends have started to abate year to date. So just something to be mindful of. And if we go to slide 20, I think Rhonda is going to cover this.
So what happened? Hunter covered that. We don't have to rehash, but corrective actions. It's not our intent. We want to be neutral. We don't want to lean too far into having like a growth overweight or a value overweight. But we did. We had a growth bias, and we are paying for it right now. Structurally, those missed weights have been historically because of the inability to rebalance. Going forward, we are addressing those by doing rebalances, taking down our equity exposure, looking at underperforming managers. We did eliminate one underperforming international small cap manager. Just the investment thesis just fell apart for them. We could no longer kind of justify having that in the portfolio. But we also took down, as Kevin had mentioned earlier, some exposure to non-US passive and a non-US active strategy just to kind of alleviate some of that pressure on the underperformance. Looking ahead, we'd like to kind of look at areas that are focused on reestablishing our dedicated global. That was unwound in a prior period. We feel that there is value there. And the way that we want to kind of build out that dedicated global is look at things like activist strategies in a non-US space, look at small cap global. There are opportunities there, and then sector and industry specific opportunity sets within international. We found opportunities, and then geographic, looking at maybe Japan as an opportunity set. Craig mentioned it. We see opportunity also in the non-US space. So to the extent that we can do some internal at a low cost in the sector and industry specific or thematic opportunities, that's another area that we'd like to exploit as well. So, with that in mind, I am going to hand off to Greg to talk about some of those internal activities that we have done and areas that we still have an opportunity to take advantage of that is more active than passive in nature, which will account for our need to grow the staff.
Yeah, so kind of just looking back over the last year, I think one of the key advantages where we've been able to use the internal capabilities is managing some of the plan-wide flows. So it's been 10 billion across the period. And that's some of those terminations we mentioned in reallocating from international to US, and then within US, kind of diversifying somewhat away from the heavy top-weighted indices and utilizing that small cap allocation, as well as the core factor portfolio, which is more diversified. And both of those decisions have been additive over the last year and a half. It's kind of some of the strategic things we've been looking at and doing. As Kevin mentioned, we implemented the $2 billion real assets staging portfolio. So working with the real assets team to kind of put that in place, and trading for that was done over the last couple of months. And kind of again, over the period, looking to allocate with investment decision as top of mind. So where we think it makes sense for favoring some of the thematic areas other than just the Russell 1000 exposure. Then on a look forward basis, some of the initiatives we're looking at. So one that Rhonda mentioned is looking at implementing a internal thematic portfolio. So this would be setting up a new portfolio to give us the ability to take advantage of thematic opportunities as we see them arise. So this would kind of involve building out a framework where we'll leverage some external resources, look to onboard some new internal resources where needed, kind of make sure we can do this, and that is something we have confidence is going to add value to what we're currently doing. Alongside this, just continue work on the development of what we're doing internally. So we currently have the core factor portfolio. So kind of on an ongoing basis, just looking to see if there's ways we can expand upon this, just to make it more additive in the future.
I'll make maybe one comment for you all. So I think you kind of started this off around this and, more boring part of the equity portfolio, but I think what doesn't get talked about a lot in public equity is that it's become extremely inefficient over the last 5 to 10 years if you're a long-term investor, because everybody's short-term. So your ability to create 10 or 20 bips of value has gotten a lot better, particularly through these initiatives you're working on. And that's only 20 bips make a huge difference, obviously, overall. So where you're thinking is the right thing, but like there's more value add. I mean, you want to index most of the public book, but around the edges, there's more ability to create value, in my opinion, today than there was 5 or 10 years ago.
Yeah. Thank you for that. And thank you too, because, Dan has sent over a number of names of folks that, have the ability to kind of provide us with that excess return at the margin. And so, we encourage you and continue to ask, anytime you see of these really good names that you feel like we need to diligence a little bit more, send them our way.
Be careful.
I know.
Quick question. I mean, and I know it varies by kind of what market segment you're in, but just kind of rough cost on creating an internal portfolio.
I mean, additional costs would be close to zero.
Yeah.
Yeah. As we need new resources, those would be additional costs. But I think like account costs, there aren't any, right? BNY, and then the trading system's in place. So yeah, effectively zero.
Where we see additional cost is, so if you look at what's up on the board, these are the existing internally managed portfolios in the asset class. Like internal U.S. core factor, that is, doesn't have intent to add alpha at the security level, right?
Right.
In the sense that we're doing alpha scoring or information coefficients and things like that. But that is one of the intents, is to look at thematic portfolios where it may be a special situation that's going to last for a relatively shorter period of time. But there, we would like to be able to bring in more third-party research and support, and then an additional, team member to help on fundamental analysis as well. So I think with Greg and the broader team, we have a good, strong quantitative focus. But if we want to go to adjacent opportunities in trying to add active return, not just thematically by tilting away from the main portfolio benchmarks, then that could be where we need additional resources. But again, in the big picture, that's really not material in terms of the amount of resources that we would expect to deploy, at least in the early stages.
And right now, to Greg's point, cost is negligible, but this is all domestic. As we continue to kind of look beyond domestic. Exactly.
If you were going to do a small cap passive, you just do that internally and not go through a ETF vehicle or anything on that side.
Well, interesting.
Yeah, I think so. We do use an ETF currently. I think the thought process was that if and when we find, an active strategy to replace that, it would fund that. In terms of doing it internally, I think just, if it's 2,000 names, just operationally, a bit more time consuming. So we'd probably need, an extra resource on the trading side of things at least.
It's an ROIC question. So 19 bips on IWM versus what it costs. So
Yeah.
I think I also want to reemphasize, there's a traditional way to create active returns, which is managers who are doing security selection, industry, country. I think where we've had some more recent success, and it's probably going to be more impactful, is instead of trying to roll up a lot of active managers, it's having these tilts at the top, right? And so this is a good example where we intentionally allocated to the internal core factor Since 2025, we've expanded that quite significantly. And it was really intended to be more strategic in terms of like where we felt the risks and the returns were in the market. And relative to the Russell 1000, over the 1 year, that added almost 200 basis points of return, right? So there's more risk there. There's not as much breadth in terms of the active decisions, but it can be quite impactful even on a $60 billion portfolio.
Yes, yeah. So just kind of final side on this, just on the performance side, on the core factor portfolio, the main drivers are those factor exposures it takes. So kind of over the last year and a half, it's benefited from being long value and momentum. And then kind of interested to see a lot of the outperformance recently has come from security selection within the semis space. And so that's really just been broadening out of returns within that industry away from NVIDIA. So being underweight NVIDIA, overweight a lot of those other semi names has really driven some of that performance.
Next slide. Next slide. Okay, 2026, 2027 strategic objectives. We'll wrap it up here. Really want to just kind of hit on these points just briefly. Staffing, small but mighty team. I mean, my hat goes off to them because no 2 days are the same. It's just they're constantly just kind of moving from one thing to the next, just trying to kind of monitor and manage this portfolio. But as we continue to kind of grow on our objectives, we're going to need more support, more help. Internal, Greg's talked about. Global, I've mentioned, and then the private to public equity. The strategic plan requires us to kind of seek out these flexible opportunities for deal flow. We found success in that area through, the relationships that we built with our external managers, and we'll continue to do so and continue to lean on them for support and feedback on these investment opportunities where they may be an attractive fit for the corporate equity portfolio and looking at sizing and scale for those opportunities as well. Do we have any questions? Oh, I did mention hedge funds. That is an area Hunter's looking at a little bit more. This kind of straddles, mostly the hedge fund opportunity sets and ties area under multi-strat, but we do have the ability to invest in hedge funds that are primarily equity in nature. So looking at more opportunity sets that maybe rest in the equity long short, looking at maybe some of the sector focused strategies would be another area. Activist strategies I mentioned. And then lastly, we are in the latter stages of implementing a biotech portfolio. We feel like there is opportunity. We've had those in our portfolio previously. They were a benefit. We still see value in adding those now. And so that's been something that we've been working on and we hope to finalize very soon. Any questions?
Thank you.
Well, thank you.
Now I'll turn it over to Kevin for the strategic plan. Yes. So I'm going to hit the highlights. Next slide in a second. Appreciate everybody's participation along the way in terms of helping develop the strategic plan. We were able to utilize RVK as a facilitator, both in discussions with individual board members, as well as doing focus groups internally. We did some survey work and then we iterated both that white paper that was sent along with the materials in the appendix, as well as these actual slides that summarize the strategic plan. So I think the main takeaway, the first two slides are really just executive summary, is this idea, you've heard it repeatedly, the term compete, that we actually are competing on a day-to-day basis in terms of getting access to the best managers, to deal flow. We don't necessarily think about it that much, but we compete for issuance in Jeff's book. It shouldn't be a foregone conclusion that we get all the bond allocations we want. And so that notion of where and how do we want to compete and how do we expect to win, we think that that's key for how we think about the strategic plan. This is the 5 strategic initiatives. I'll come back to those in more granularity in a second. We obviously have to be competent and engaged in all of the asset classes that are part of our investment policy statement and the strategy. But in terms of where we emphasize, where we're going to focus our time and attention on what we're hoping to achieve, we've highlighted for both private markets first and then on the public market side, where we think we should be emphasizing at the moment. Over a 5-year horizon, this could change. So notably, we think 25, 26 are really good times to be leaning into venture capital. And we're getting access to what we believe are top tier firms. So we should take advantage of that. And then if you go forward 3 years, 4 years, we don't know. It may not be the time to be more focused on venture and growth. Maybe there'll be a different emphasis in the portfolio, but that's on management to kind of figure that out. Now, what I've marked in underlining here is just to flag new capabilities that we expect to be investigating and pursuing to different degrees over the next 5 years. A lot of it is around co-investments, selective directs. As I commented earlier, there's a ways to go for us to execute on a direct corporate or entity level where we're on the cap table. But there's also initiatives like under credit, which this is described as a potential matrix internal implementation of high yield bonds and leverage loans. And it's a potential matrix because it could happen entirely in Ronald Funderburg's team, but it could also happen in Jeff's team, right? We have a good longstanding credit research function there. They focus on IG only. But it might be that we extend that research platform to support. And then the actual use of a public high yield and leverage loan internal portfolio doesn't necessarily have to be at a lot of scale all the time. It might be small and it might do special situation type things where we just want to load up on some exposure we like, or we may flex it. So it may be flexed when, spreads are 1,000. That happens, right? And it's harder to transact. But in any event, all that's to be determined. But that's part of the plan. On the real estate side, we're heavily overweight core relative to where we think we'll be long term. So there does need to be some rebalancing. We need to do it thoughtfully in light of market conditions and the specific assets that we have in the portfolio. And there again, we expect that we can do more in the direct space, more joint ventures, things like that. On the public equity side, Rhonda's and her team have already kind of addressed the notion of doing these staging portfolios across asset classes, but we have the implementation capabilities in public equity, and then looking at extending some of our internal management. On the multi-strategy there, the potential expansion is around total plan overlays. And again, that came up earlier. Thank you, Stephanie. So where do we see our advantages, our comparative advantages? It's listed here as essentially 3. One, long-term flexible capital. So, it's awesome the board has given us this flexibility within the investment policy statement to not have target allocations, say for private equity and real estate, and we have broad bands. And so we can go where the market, has kind of returns that hopefully we can harvest. We need to be a trusted fast partner. I think executed on that to a certain extent already, but that's an area for kind of more enhancement over time. Being able to work in deal time with a sense of urgency, with a focus that's appropriate for what we're trying to accomplish. It also means for us to be trusted and fast, that when we engage with the market, we have to have the bandwidth, right? So this is another topic that, we're talking about internally. that when we do get a fat pitch, which will happen on occasion, and if we ever get a big dislocation, then those fat pitches will be many more and fast moving. We need to have that bandwidth to be able to flex, to be able to react. And then the third one is, I changed the title relative to what I sent you all, which is absolute return ethos, which is we are in fact different by signing on for this 6.5% as our primary benchmark, that we can do things. Ron and his team have executed really well on like commercial real estate mortgage exposure at size. So we hope to get some excess returns there, but it's mostly just, it's a undercapitalized sector in the market that we're taking advantage of, and it's a nice return compared to the 6.5. And it's not much more complicated. Does it need to be? And that gives us an advantage in the marketplace, right? That there can be things that look interesting to us, but not necessarily to others.
Can I maybe a question, observation / question on the private markets page? When I look at that, I think about internal capabilities where you're thinking, I see low clock speed type businesses, low clock speed assets as where we're trying to build internal. Is that a correct interpretation?
I think that's fair. Yes. Yes.
It makes sense, but I want to make sure I was.
Yeah, I think that's fair. I think, I don't want to let up on the pressure that we have disappointing investments on the private side we need to exit. We need to actively manage those, right? So I would like to see more turnover in the private portfolio, but by and large, we have the ability to take on duration. I'm going to just jump forward to the initiatives and just hit a few high points. So institutional continuity, this one is very much front and center with the feedback we got from the board and the board members. And it's really a board-owned type of initiative. We're doing well in terms of codifying our governance and all of our operating approach so that we have continuity as there's changeover in the treasurer's seat, changeover in my seat. I think this is quite clear. In terms of communication, we work with the department's comms team. They take a good strategic approach, and that's the way we handle media and public inquiries. Try to put as much on brand as humanly possible, and I pick up a few things, and that might expand as well to the broader team. But we think that that's well along the way. We will, through the next year, do a full-blown succession review for the CIO role as well as the senior leadership. And we'll use a third party to facilitate that and be able to have them interact directly with the individual board members and the board as well. And I think succession planning is something we need to drive more deeply into the organization. And that whole notion of there's internal versus external candidacy, there's readiness, there's different skill sets that need to be developed as you move from a contributor to a leader, technical skills, behavioral, all that stuff. So that's all part of what we'll do with the succession review. And then build a regular board staff rhythm. That's something, again, we heard from the board as important. We completely are aligned on that. So we'll have the deep dives on the asset classes and other areas as well from the team like risk. So we'll be doing that in the future. The talent and operating environment, as you would imagine, given our business and the fact that we're kind of new and evolving in some ways, that this has to be a strategic initiative to make sure we have the top tier talent, that we can attract them, retain them. So here again, it's building clear career paths, promotion criteria, rating and deepening kind of a culture of coaching and feedback, prompt and straightforward. The comp plan is essentially in place, but we need to implement as we go through the next year. And next layer of leadership, again, I commented on that already. The total plan operating system. So this is a couple components. One is I feel there's a need to have more kind of individual ownership of this total plan portfolio view, and that we should have the ability to manage liquidity, hedging, both kind of from a risk perspective as well as otherwise, maybe return seeking, and that should be owned by some person, some team. We're doing it through a committee currently, which is working out fine, but fundamentally we need to have somebody own that total plan component. And with that would be a data setup and really be able to apply AI against a lot of these issues. So we are quite excited about AI. Private market platform, we've largely talked about this already, right? In the context of private equity, the notion of having a go-to-market plan and really build out a structured platform that will support co-investments and be able to close those, and then restructuring and rebalancing the real estate portfolio. That's top of mind. Tessa is not here today. She's not well. But that is something that she and her team are very much on top of. And then the public market edge is that we do take scrutiny towards any internal active portfolios. We don't give them a pass. We look at them just like we would an external portfolio or mandate. But we do see that there's opportunity to kind of expand some adjacent opportunities. Some different things that you've heard from the team already today. And then we do have to build out some of our internal systems as well. So the risks, going too fast, doing too much, right? We need to be conscious of that. So any kind of breaks that the board would like to throw up periodically, we're definitely welcoming those. Crowding in private markets, this has been an issue for a while. Right now, again, it's a tough fundraising environment, so we're being welcomed in places that historically we've not been able to get access. But there's still this notion that there's just so much money chasing deals. There's so much money that wants and then the board oversight on each of these will be giving at least annual updates, but there will be progressing or not progressing. And if there's any shift in priorities, I think that's really, really key to doing strategic planning in a way that's going to produce good results, right? We've had some episodic volatility in the markets, but the returns have really been, quite good. That won't continue forever, and we'll have to shift our attention from time to time to just dealing with the assets and less on the organization building. So that's something we'll work with the board, that maybe some things will have to get delayed and other things might get accelerated. So try to go through that quickly and hit the high points. So I'll stop there.
I just express my appreciation. I thought it was incredibly well thought out, and gave Chris took some feedback. Well, it's more clear. I think it's a very good document. So thank you.
We appreciated your very blunt feedback.
Nice.
Lovely tone.
Appreciate the work. Thanks.
Thank you all. Great job putting this together.
Okay, I think that takes us on to the last two items. Yes. Chris says 15 minutes to wrap up both.
Sure, no problem. So we have kind of two components to this next item. One is the proposed budget for the next fiscal year. And then we're going to walk through the cost allocation methodology, which leads us to kind of our proposed admin fees that we're going to be charging our clients going forward. So I'll hit the budget first. Hopefully it's fairly straightforward as well. I'll be brief. So our requested operating budget for the next fiscal year is 40.4 million. The proposed budget is approximately 2 basis points of the projected 3-year average AUM, which is below the 3 basis point cap that is set by statute. Looking at, I'll touch quickly on current fiscal year where we're at versus that, and then I'll go into details of the proposed $40 million budget. So we can go to the next slide, if you don't mind, Michael. So our current budget, which was approved, if you recall, in November of last year, so it's almost halfway through the fiscal year, but this is our first budget for NCIA. If you recall, the approved budget was for just north of $26 million. Our projected actual expenditures will be slightly under that by about $2.5 million. So it's 23.5 million roughly. So this is actual through March and then projected for the final quarter of the fiscal year. So you know where those numbers came from. So they're not final, but the underrun was mainly due to personnel services. And that was really more of a factor of the timing of hiring new staff. As we hire more, we're obviously going to see more personnel services needed on that item. So I feel like fairly close there. And then obviously our budgeted recommendation is going to be pretty significantly different for the coming fiscal year. So if you want to go to the next slide, please. So as I mentioned, the requested budget for fiscal year 26-27 is 40.4 million, which is 14.3 million more than the current year's budget. But still significantly under that 3 basis point cap. And you can see in the table in the bottom left, the change in the budget is significantly driven by personnel services. So about 75% of that $14 million increase is due to personnel services. And that's 2 things that's driving that. One was the projected increased staff count for the next fiscal year, as well as the first full year with our new compensation structure, including the first incentive compensation payment next March, I guess. The other 3 categories, we did see an increase of operations and admin was mainly travel related. NCDST shared services did increase some, mainly due to headcount of NCIA increasing, as well as I think costs of the department in general increasing some as well. And then contractual services, we continue to build out some of our research data capabilities as we kind of normalize the new operating model for NCIA, which leads to some additional costs related to that. On the next slide, that drills in a little bit more on the personnel and the operations. Again, I already hit it. I don't want to belabor it. But the 10.7 million increase in personnel, the 7.2 million in the personnel line item was 40% due to the new compensation structure, 60% due to projected additional FTEs. And then we modeled in for the first time the incentive payment authority. And this was modeled in at the cap of the incentive to give us room within the budget in the event we hit that. Obviously, those awards won't be known until the beginning of next calendar year, but we modeled it in at the cap. Now, going forward, that number will hit a normal run rate at some point, but it will take a few years to get there. Because if you recall, the first payments, you get 50% and then 50% deferred. And then the first payment as well was tranched in at a 2/3 rate. So we'll likely see that number take up as we get to a normal run rate. But this was for the first fiscal year, this is the cap on the incentive payment. Already hit the operations, really was an increase in travel that drove that small change. And then, as I mentioned, on the contractual services, it was more of moving towards a more kind of normalized operating model. Legal support increased with more transactions, with some projected organizational setup costs, that type of stuff. So that's where you see the legal increasing as well. But that's really it on the projected budget, the recommendation. Happy to dig into any of that. Hopefully it's fairly straightforward.
I just had one observation, and Kevin, I think you've got the authority to exceed the operating budget by up to 10%, right, on the operations and administration. I just felt like the education and training number was light, given how many people you're planning to bring on board.
Yeah.
So you might want to spend more there, and I just thought I would throw that out.
So on slide 7 here, this is the recommended budget resolution, essentially approving the proposed fiscal year 26-27 operating budget of 40.4 million, and noting the following kind of delegations and guidelines. 1, authorizing the CIO to exceed the approved operating budget authority by up to 10% under exigent circumstances for non-personnel services without a prior budget amendment. Number 2, the CIO has the authority to create positions and employ staff as necessary to assist the CIO and the board, subject to the approved budget for personnel services. And then again, the recommended budget equals approximately 2 basis points, which is under the 3 basis point cap, and we expect to stay under that cap as well. And then the 4th delegation here is that the board will separately consider management recommendations for the system of administrative fees, which we will touch under the next topic.
So one quick question. So everything proposed is all good. And I think it's good to have a buffer, but what happens procedurally if we were over the 3 bips? What do we have to do as a board, or if we had I mean, that's only going to happen if we had a massive market sell-off, right? What happens in that scenario?
So the way the statute reads, I don't have the words tip my tongue, but essentially it's, you approach it as a fiduciary exercise, right? And so there's an expectation that we're not going to go over that 3 basis points. But if it was, a massive, like a 08, 09 type event, that might trigger us going over, the board needs to make a decision around, okay, so how do we handle it? Do we just, extreme scenario, do we slash headcount? I would think not. But again, that could be an option. We could stall future hirings. We could come at it from a different perspective, right? But that's the way the law is written. So it isn't compelling an action that would not be consistent with your fiduciary duties.
And there's not a cure period.
Or an averaging or a, you have the language in front of you.
The way it reads is if for some reason it cannot fit within that 3-year, the NCIA reasonably determines that because of special circumstances, including applicable investment restrictions and the like, it's clearly not prudent to do so. But there's no statutory required time period to set us right effectively.
Again, it's a 3-year average too, right? So it would have to be a pretty substantial downturn and prolonged, I would imagine.
Yeah. But in the normal course of business, we should be able to plan around this so that we never go over, right? We don't want to have that kind of be a point of insertion and second guessing by the General Assembly notably. But by the same token, we're happy that the law doesn't create this hard and fast requirement that somehow you just slash costs, regardless of what the outcomes might be, because ultimately we need to deliver the returns.
And maybe saying a little bit of the quiet part out loud, the 3 basis points was established not as a target.
Right.
Yeah, exactly.
And so the intent is to run with quite a bit of buffer between the 3 basis points and where we think this normalized can run. I'm not aware of a scenario other than maybe the 1930s where you'd have a drawdown that would get you to 3 basis points from where we think we should run. But nice to know the corner case outcomes.
We should be approaching that normalized kind of run rate, right? I mean, certainly a ramp up here, but we're not going to see that continue.
This is maybe an observation and then a question, and that is clearly this, to me, looks like an incredibly responsible and constructive budget. And the primary differences are driven by fact that we were understaffed and underpaid.
Yes.
Was there any feedback from any stakeholder after the compensation study was discussed? That was all open information. Was there any feedback to you or your office or?
Yes.
Okay. Because we're getting ready to show them a significantly larger budget.
You can't separate what is going on with respect to the earnings of the plan from this conversation. So having a material increase in budget last year and again this year relative to this team making a lot of money for the state of North Carolina makes that feedback pretty uniformly positive. It won't always be that way. But at least at the moment, people get the idea that if we can spend $40 million as a state and get $25 billion over a year and a half here, that's probably a good thing to do. And so that's the feedback over and over again at the moment. So just keep doing that, guys. Yes, right. It's that simple. It won't always be that way, of course. And so being responsible, being thoughtful, being nowhere near the cap, being very open and public about what we're doing, why we're doing it. I think that future-proofs this conversation.
Either move on to.
Let's do the budget approval now.
So I will now accept a motion and a second to approve the fiscal year 2026, 2027 operating budget of 40.4 million, subject to the delegations and guidelines as presented on slide 7 of the NCIA FY 26-27 budget section of the board materials.
So moved.
For a second. Thank you. I'll call the roll, please.
Mr. Roberts?
Aye.
Treasurer Breider?
Aye. All right, we have a budget. Thank you. Move on.
Okay, so the last item is the cost allocation methodology and administrative fee. So we went through a process, as Kevin mentioned a little bit earlier, to, we're moving away from allocating the cost directly to the portfolios and moving into a model where we're going to be charging our clients an appropriate fee to cover the costs of our management, right? Not a profit generation. We're not trying to earn a profit. It's to cover the costs and to create a reasonable reserve so that we can manage the costs appropriately over time. So we went through a process to take a look at how our costs are earned per client. So we have our 4 main clients, right? We have NCRS, we have our cash management program, we have our supplemental retirement plans, and then we have our ancillary AgFit program. So, we determined a methodology to allocate the costs of all of NCIA to those 4 clients. If you look at, let me just go to the next slide, please, Michael. So in terms of how we allocate these costs, we kind of use this specificity before simplicity kind of mentality around, where we could, we directly allocated the costs to a specific client. And that was mostly applicable to NCRS, because as you've seen in the slides that NCRS is by far the vast majority of the costs of NCIA. So where applicable, we directly allocated it to the client. Where folks work across clients, which happen with a number of personnel related roles, we allocated the specific time spent per role to the different clients. And then for specific vendors, for other service providers, we just did it on a usage base. How much is each client using the specific service or vendor? And then for general kind of operations, administration, or services that we use across NCIA as a whole, take Backstop, for example, as our CRM or our new personal trading platform, and examples of that. We use kind of an aggregate staff time model where we determined in aggregate how much staff time spent on each client. So that was really kind of the 4 sort of allocation methodologies that we used. We allocated essentially every single line item that was going into our
next fiscal year's budget in that way, using one of those methodologies. And then you can see on the next slide, end of the, let's flip forward. So the next slide is our total budget. You just saw that. Flip forward to slide 5. You can kind of see the client allocation results based on that methodology. So as expected, and the NCRS dominates the usage of kind of NCIA resources. So we allocate roughly 93% of the costs to NCRS, and 4.5% to the cash management program, just over 2% to the supplemental plans, and then just under 0.5% to AgPIP. So as we think about how much we should charge clients, how much the costs are, that's kind of where we started. If you flip to slide 6, this kind of is a good summary of kind of where we ended up, right? So you can see the costs on the bottom right there. The costs in basis points as a percent of AUM for NCRS was basically 2.5 basis points. And then for cash management, for SRP, and for AgPIP, roughly 0.4 basis points. So that's the cost that we currently have in our projected budget for next year for our 4 clients. So as we thought about what we should charge, we wanted to build in a little bit of buffer so that we could create a stabilization reserve in the event that AUMs change and we need to make sure we have enough funds to operate. So the proposed fees for the clients are on the page there. So 2.75 basis points for NCRS, and then 0.5 basis point for the other 3 clients. So those are the proposed rates. If we charge that, the projected fee revenue using kind of our projected AUMs in total would be a little north of 44 million. With the just approved budget of 40.4 million, that gives us a reserve at the end of the first year of roughly $4 million, right? Now, again, this all shifts based on the AUM specifically of NCRS, because they're the biggest driver of this revenue at 2.75 basis points. So we did some stress testing there to determine kind of where we could potentially be in trouble if NCRS dipped down. And I think there is a little bit of risk there initially until we get that reserve in place, where if we have a 10, 15% drop in NCRS as a whole, that revenue wouldn't be sustaining our budget essentially. But again, the way we're billing, the way we're planning on billing, and the billing methodologies right here on this slide as well, is in advance using the prior quarters or prior 3 months average AUM, right? So there is some smoothing there. It would have to be probably a pretty protracted downturn for us not to be able to at least meet our minimum budget under these proposed fees. But I think there is still some risk there. In terms of our reserve, you see we have our reserve policy right here on the slide. Is essentially, we're creating this reserve to have the ability to stabilize the fees, to avoid timing mismatches, again, market-driven shortfalls. We need to have a reserve in place so that we're not having to come back to the board to change what we charge clients or whatnot. So over time, as that reserve builds up, once we feel like we have a sufficient amount, we would certainly, any amount above the necessary reserve, we could be used to reduce subsequent fees for all the clients involved. So it's kind of the thought process. We don't have a hard kind of number in terms of a reserve that we want to put in place at this point in time, but it's going to take some time to get there. Because with this, it'll build that 4 million buffer, per year roughly, right?
Yeah, we'll be reviewing it each budget cycle. And if for some reason it does rise more rapidly, we expect to be given an interim update as well.
Yeah, so in terms of kind of how we built this methodology, we wanted to make sure that, it was repeatable, it was auditable, that there was good governance in place. So we're building controls in place to handle all of that. We are moving to a completely new model, so there's certainly some transition that takes place here. We have a slide on that. I think slide 8, if you want to move forward to that. So
essentially, we're creating the necessary accounts for NCIA as an organization to be able to have operating accounts to fund these fees. We're creating processes with our partners, with FOD, to help us operationalize and build these the necessary controls in place to make sure that these fees are assessed appropriately, these fees are charged appropriately, and that, like I said, we have it available. So it's, it's a repeatable process, it's auditable, and the governance is in place for annual review by the board to make sure that the board's comfortable as well. So essentially the transition, like I said, right now we're in the middle of creating accounts needed, setting up billing and payment processing for each client. Next quarter is going to be when we have the first charge. It's easier to do with, I guess, NCRS and cash management since we control that whole process. We're going to have kind of formal notifications out to the other clients, SRP being one, and then all the underlying clients within AgPIP. If you recall, we have roughly 75 to 80 clients within AgPIP that they've never been charged anything before in terms of an administrative fee. We can charge the fees on the underlying products, obviously, but so this will be new. We've had statutory authorization to do that for as long as this program's been in existence, which has been about 20 years now. But this will be the first time that we charge them. So obviously we want to make sure we notify them appropriately, give them the appropriate time to digest that and ask any questions or leave the product if they don't like it. But so we're going to be doing that over Q3 as well. So we're going to phase that in a bit. And then foresee kind of Q4 and forward kind of moving to normal operations where we charge the clients quarterly, and then we have an annual review process with the board alongside the budget recommendation for the next fiscal year. So happy to answer any questions on that. I just covered it pretty quickly, but.
So it doesn't require approval. It's mentioned that you have statutory permission to do so.
So we have statutory.
We have to approve it, for example?
No.
So there shouldn't be an administrative issue.
Yeah, we'll just essentially be notifying them. Yeah, we'll be notifying them and giving them appropriate time to on the next questions. So essentially what we're asking for the board to do today is to approve the cost allocation methodology that I just laid out. The client fee rates up to that proposed recommendation, and then the stabilization reserve framework as presented on that slide.
The only comment I make, everything on here is good. When we review this in a year, I'd encourage you to develop some methodology around how to determine, make it a little more automatic on how the ultimate reserve number is determined so that there's full transparency to all parties involved. It's going to take time to figure out what that right number is.
Yeah, we've been talking about it, but yeah, we just figured first year it's going to take a little while to build it up to where we're comfortable, right? Because we're running at, roughly a $10 million per quarter run rate, right? So we got roughly less than half a quarter that we're building up in a year. So yeah, it'll take a little bit of time, but no, I appreciate that.
It doesn't matter now.
If I'm a member, I'm going to want to know how big a reserve you're going to have. So you might as well go ahead and do that sensitivity analysis.
Yeah.
Okay, I will now accept a motion and a second to approve the fiscal year 26-27 cost allocation methodology, the proposed basis point administrative fee, and the stabilization reserve framework. Is there a second? Second. Mr. Roberts, call the roll, please.
Mr. Ward.
Aye.
Mr. Brunner.
Aye. Okay. Thank you. We will move on. We have time for board comments. If anyone hasn't made any they would like to. Talkative group, which is good. Okay. We will move on to public comment. Do we have any public comments?
That's my knowledge, man.
Okay. We'll consider the public comment period closed, which means we will get to the most important motion, and that is the motion of adjournment. Before we do that, I just want to say thank you to everybody. It is not often that the state sets up an endeavor like this, and it is just a privilege to be have a front row seat to all the hard work that you guys are putting in and making it a reality. It matters to all 11 million North Carolinians. And so thank you for everything you're doing. It's really fun to be part of. And we'll look back on this moment and really be proud, both tomorrow, but also decades from tomorrow. So thank you, everybody. And with that, I will accept a motion to adjourn.
So moved.
Second, we'll just say aye. How about
Aye.
aye? All right. We are adjourned. Thank you, everybody.